steady trajectory, a linear kind of linear kind of progression. It usually comes suddenly, and there's a jump up in unemployment. That's what some people are fearing, including Citigroup's Andrew Hollenhorst.
Jobless claims data, 8:30 Eastern Time. Check out the scores in financial markets, all-time highs at the close on Wednesday on the S&P 500 and the NASDAQ 100 for the first time since March. We had some weight to it, just a little bit. We're up by 0.05% on the S&P. In the bond market, yields unchanged, 4.33. Coming up this hour, Matt Miskin of John Hancock Investments as the S&P hits a new record high. JP Morgan CEO Jamie Dimon live from Paris with Francine Lacqua, and Michelle Ma of the MasterCard Economics Institute reacting to jobless claims data. We begin with the big issue. Good news is good news. A caller CPI print sending stocks above 5,300 for the first time ever. But John Hancock's Matt Miskin saying this: in terms of markets, we are still firmly in the bad news is good news regime. This can't last forever, as weaker economic growth likely means lower revenues, more defaults, and eventually plays into a weaker jobs market. Matt joins us now for more. Matt, just walk me through the regime you think we're in.
Yeah, we still think we're in this bad news, good news regime, and it's one that is challenging for asset allocators because Treasury bonds are acting like small cap crypto stocks. I did not see this coming. This is something relatively new to this cycle. You know, I'm looking over at the CFA books and the Intelligent Investor and other finance books, and I'm like, where were you on that? But this is a challenging market and one that we think is going to be a bit counterintuitive. We think it's a phase. We actually like the Treasury part, the higher quality bond part of the market, in that rally that we're seeing than the junk rally. We would trim into strength of some of this lower quality market. Right now, the markets in general are sunning themselves on soft landing island. And we just think this is a great time to prune some risk.
So, Matt, you don't want to get out the umbrella, take a rest, and take in the sun? No?
Have a cocktail, maybe. No, we don't, John. You know, it's something that, you know, we think it's a bit of a welcome gift. And right now, the bar is lower for Q1, nearly for all these economic data points. So the CPI report, for example, inflation, this time last year was relatively high. So the year-over-year comps, what you're getting is you're rolling on some lower data, but the last year data was actually much higher. From here on out, inflation this time last year fell meaningfully. If you look at the month-over-month data. So now the bar is going to be harder to beat. Similarly with earnings growth right now, the bar in Q1 was lower. The bar goes up from here. The estimates for the street are about 9% in Q2.
It's been 10 minutes time now at 8:15 a.m. Eastern Time. We expect comments from ECB's Villeroy, who speaks at the IIF conference on sustainable finance.
Times on a 4 PE on the S&P. That's about as good as it gets being priced in. So right now we're looking for income as a return driver, alternatives. The dollar we think actually could be a great diversifier for portfolios here, and thinking about defense more broadly.
So bonds have rallied, stocks have rallied. You alluded to maybe liking the bond piece of that rally. Let's just sit on stocks. How would you fade that? What would you trim? Can you be more specific? Are we trimming what's happened in small caps the last 24 hours? Are we trimming what's happened with big tech over the last 5 days? Trimming the all-time high in the S&P, the NASDAQ 100? Where would you trim?
Yeah, we would start with the Russell 2000. And the Russell 2000 right now, we hear a lot of fundamental thesis around small caps being cheap. And actually,
Bank of England's green says we see a moderate consumer-led recovery in the UK.
Nearly 40% of the Russell 2000 companies don't make money. They're not profitable. In addition, what's been driving small caps as of late are crypto miners and meme stocks. So if you have a fundamental thesis on the Russell 2000 that it's cheap or there's some sort of other macro thesis, what is actually driving it is a lot of speculation. And if you want to go long speculation, actually, that's a great way to do it. But that's actually the place we would trim first. Internationally, economies have been improving. We've been warming up to that, Europe in particular. But we think this China trade might also be starting to get stretched here, overbought. A lot of headlines. Every day you get a new headline out of China. But for us, the fundamentals still aren't strong enough to support it.
So, Matt, you're not in the camp of buying necessarily European bonds to try to diversify away from the U.S. and hinge yourself more closely to the easing cycle. That's not something that you're kind of leaning into?
You know, it's something we're looking at, and duration is a tailwind there. I get it. It's been working. So congrats to those that grabbed that. But what we're seeing is just a massive yield disadvantage. You know, we're thinking about bonds more as a longer-term investment for clients. And we're getting, you know, there was a point where we're up almost 6% yields on just a kind of mild credit bias in portfolios. Municipal bonds we like. But what we're seeing is the yield advantage is just so amazing in the United States. I know, Lisa, I'm really getting excited about the yield here.
You are. It's absolutely. It's inspiring. It's infectious, Matt, and I love it. Keep going. One thing that you say, as you sort of paint the picture that we're in right now, is that you say that we're coming off a mini cycle of its own that really started in November with the pivot from Fed Chair Powell. How much is that actually the way to look at this? And I think that it's a really good point that essentially the promise of rate cuts fueled risk assets enough to then fuel economic growth and inflation to keep things chugging along for longer than people expected. Is that how you view things?
Exactly. Yeah. And it's just all about context. And you rewind 6 months ago and the Fed was talking about rate cuts. So what did the bond market do? They said, sure. And if, in fact, we're gonna double that. We're gonna up the ante, if you will. And so they said 6 cuts were gonna be priced in. And so pricing in 6 cuts, I mean, can you imagine if the Fed had said at that point we're going to cut 6 times? I mean,
Bank of England's Green says progress on indicators we look at have been encouraging, but have fallen in line with my expectations.
And now the Fed is having to deal with that. They're going to have to, they're trying to peel that back. But that's what a mini cycle looked like. You saw a bottom in economic activity in November, right around then, bottom in inflation pressures, and then that's reaccelerated. And now as rates have come up, we look at housing, for example. Housing is such a critical part of this whole economic equation. And housing, the NAHB housing price or housing builder sentiment index that actually came out yesterday ticked down for the first time in 6 months. And if housing's starting to slow, that's a good indicator that this cycle, this mini cycle, might be slowing. And then again, we go back to those small caps, those lower profitable companies. They're not going to like if this mini cycle is slowing. Right now, they're loving the risk on mood, but we think the fundamentals are going to deteriorate underneath the hood.
Matt, appreciate the update. Matt Miskin there of John Hancock. Looking ahead to more economic data in about 21 minutes' time. Jobless claims in America. Up next on this program, the conversation of the
Bank of England's Green adds that I need more signs of waning persistence to vote for a cut.
From Paris with Francine Lacqua. That conversation just around the corner.
In 5 minutes' time now at 8:15 a.m. Eastern Time, get comments from ECB's Villeroy speaks at the IIF conference. Bank of England's Green says there are reasons to think the neutral level of interest rates has crept up.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I had a big insight one day that women don't invest as much as men do. That, you know, we all think it's because they're risk averse, but maybe it was because nobody built anything for them.
Live from New York City, welcome to the program. Equity futures on the S&P 500 just about positive. The economic data about 20 minutes away. Jobless claims just around the corner. Now it's time for the conversation of the morning. Francine Lacqua sitting down with the JP Morgan Chase chairman and CEO Jamie Dimon. Morning, Fran.
morning, John. Yeah, it's definitely my highlight of the day. Jamie Dimon, a lot to talk about. JP Morgan Chair and Chief Executive. Thank you so much for hosting us again at your Global Market Conference. What's market turbulence looking like right now? So we have the CPI print yesterday, markets rally. Are they getting ahead of themselves?
Yeah. So I wouldn't call it turbulence. We've had good, healthy markets for quite a while. They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets which are kind of wide open. That's all good. It doesn't tell you what the future is going to be. I mean, I can point a lot of times in history where that was true, and the next year wasn't true, and so. We'll see. I don't pay as much attention to monthly numbers as most people do.
I know. So what do you think?
Israel's defense minister says additional troops will join the ground operation in Rafah in southern Gaza.
And I think the underlying inflation may not go away the way people expect it to. And I look at the future, like a lot of things we look at are kind of inflationary. The green economy, the remilitarization of the world, the infrastructure requirements, the restructuring of trade, fiscal deficits. So I think there are a lot of inflationary forces in front of us that may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation a little bit higher, and maybe that'll slow growth. And obviously geopolitics is a whole different issue. That could be determinative in what our economy does next year, and we're just not going to know.
But so does that mean you think it's 50-50 whether the Fed cuts or hikes next time around, the next move?
I really don't pay that much attention to that. The Fed will have to follow the data. And I don't know what the data is going to say, but I think they are doing the right thing to be patient right now. See what's going to happen. They may not know for a couple of months.
Shortly expecting comments from ECB's Villeroy.
That much attention to it, it means you're not worried about anything.
No, I'm worried. I just said stocks are very high, and I think the chance of inflation staying higher or rates going up are higher than other people think. So I think the chance, my view is whatever the world is pricing it for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
In the U.S. or globally?
Well, I'd say in the U.S., but also that could affect globally, yeah.
And so what does that mean for markets?
They'd be down. And credit spreads would gap out.
So why is the market not pricing that in?
A lot of happy talk.
Where does that happy talk come from?
Low rates, central banks are going to reduce rates. Maybe the geopolitical things disseminate, don't cause problems, and so the future isn't predictable like that. So I'm a student of history. I've watched all the inflection points. If you go back, my dad was a stockbroker. I go back to the booming markets of '72 and the collapse of '74. The healthy markets of '80, the collapse of '82. The '87 market crashed, the 1990 real estate crash, and almost all of them were not predicted the year before. So I look at these factors that drive these things. They're not always known. As a company, we prepare for all of this. We can serve all our clients regardless. But
what do you see as the main stress right now? Because if it's geopolitics, we talk about it. It's just not really priced in. Is it distress? Is it something actually going under that you worry about, or just multiple factors coming in at the same time?
No, I think geopolitics could create the main stress that we're worried about in terms of oil and gas prices, trade alliances. But I think the surprise would be higher rates because inflation didn't go down. That inflation's been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise. If you had higher rates and God forbid stagflation, you'll see stress in real estate and leveraged companies and some private credit and things like that.
So is unpredictability the new normal?
I think it's been the norm since my whole life.
Has it?
Yes.
Not worse now?
No.
What happens between China and the U.S., and what does that mean for your appetite of being China?
Yeah, so the geopolitical situation is very tense because of Ukraine and Russia, Iran, the terrorist activities in Israel, North Korea, nuclear blackmail. We've never had nuclear blackmail before, and this is, of course, affecting our relationship with China. And it's going to be hard to have a great relationship with China as the Ukraine war is on. We're kind of on different sides of that, and put Taiwan aside. Having said that, I think it's the right thing for America to fully and deeply engage with China, competitively. Every nation is going to do what's in their own interest for national security. So should America. We should define that fairly and properly. If there's unfair trade, negotiate that or do whatever you need to do. But the engagement is the right thing to do.
JP Morgan CEO Diamond says inflationary forces in front and may keep rates higher. Says markets have been good and healthy for a while, and inflation next year may be in the cards.
Anti-nuclear proliferation, anti-terrorism.
But what does it mean for a bank working in China, actually given all of this volatility?
They're cautious. I mean, China, if you look at China from a risk-reward basis, it used to be very good. It's not so good anymore because all these things can go wrong. And remember, we bank, I mean, I've got the number, but 1,500 multinationals in China. They're not leaving China, so we're going to serve our clients there. We're just much more cognizant that the risk is higher. And I put Hong Kong in that bucket too. We kind of look at China, Hong Kong as one at this point from a risk standpoint.
What does the Trump administration mean for the U.S. economy?
I don't know.
Why? Because it's unpredictable, or because we're too soon to actually trying to figure out the policies that he would put in place?
So if you look at history, who was elected president may not necessarily affect the next year. That's kind of like we're a big tanker and that's going to happen. I think the much more important thing is what we do in the geopolitical situation. I've always been quite clear that American leadership is provided to keep the world free and safe for democracy. And that means economic alliances, which includes trade, by the way. I think we should spend more time in trade. It means NATO. It means that Russia should not win in Ukraine, because if they do, I think it could tear asunder this Western world.
I know you've ruled out being Treasury Secretary.
Yeah.
Why? What would it take to get you into politics?
I don't think I'm suited for politics. I love my job, and so I'm not sure I want to do something like that. And I can hopefully.
But even if you got the call, would it be hard to say no?
I don't know. Probably yes. I love my job, and I have no interest in leaving and doing anything else. So.
We're in France at a global markets conference. What are you expecting from Basel III? What will Jay Powell put in place in the new rule book?
I should mention, by the way, because President Macron has done an outstanding job here. Pro-business, got us to move our trading floors here. He wants to grow his economy. There's much more innovation. We had a thing last night about innovation. So, look, Basel III, we've been quite clear. We thought it was excessive, not well thought through. I would love to know what the end game is. What are they trying to accomplish with private credit? What are they trying to accomplish with, like even the other day, 80% of mortgages left the system, and now the government's talking about having a bailout system for mortgage companies because they're no longer in a bank that has the ability to provide liquidity in tough markets. That would be the same thing in market making. So they're looking at it. I trust Jay Powell to look at and analyze what they need to do, how they need to do it. The other thing, which I'm not sure Europeans know, I have no idea. And it may end up in a lawsuit or something like that. But the amazing thing to me is that America ended up, the end game, 30% more capital than a European bank in America. And I just, why would
So in 10 minutes time now at the bottom of the hour, we're due a slew of US data with the weekly initial jobless claims, forecast 220k on the prior 231k, with a range of 231 to 210k expected. Continuing claims, forecast 1.78 million on the prior 1.785 million, with a range of 1.8 to 1.745 million expected. Let's get the US housing starts data. The housing starts number forecast at 1.421 million on the prior 1.321 million, with a range of 1.49 to 1.328 million. The change is forecast at 7.6% from the prior minus 14.7%. The US building permits number forecast is 1.48 million on the prior 1.467 million. The change is forecast at 0.9% on the prior minus 3.7%. We also get the US Philly Fed Business Index. Forecast is 8 on the prior 15.5, and the US import prices month over month forecast 0.3% on the prior 0.4%. Export prices, the forecast is 0.2% on the prior 0.3%.
I've got the number $5 or 6 or 7, $800 million a day. When you have 1,000 people, you tend to hire more.
Bank of England's Green says sterling has already shifted a lot. Some of different rate expectations, Bank of England and Fed, are already priced in. That's Bank of England's Green saying again that sterling has shifted a lot. Some of it's from different rate expectations from the Bank of England and Fed already being priced in.
Those things do make a difference. And very importantly, they don't just lift up JP Morgan here. We pay a lot of taxes here, which helps lift up all citizens. I don't think President Macron did that for JP Morgan. He did it because he knows his country needs to grow, bring in innovation, and that's how you build a better country.
So the chief executive of the largest wealth fund in the world says that actually America's doing much better because Americans are less lazy or work harder than the Europeans. I mean, is that fair? Is that regulation?
I hate total blanket statements like that. I know a lot of Europeans who work hard, but I think when you see the thing about work hours, I think it is somewhat true. Americans are hardworking. Anywhere you go around, Americans are hardworking, but I see that here too. You know, I don't think, and the innovation people you meet, they're working just as hard as the innovation people in the United States.
So you also, in terms of headcount in the UK, I think it's at the highest that it's ever been, and you're also you're giving money to try and retrain. And you've recently met with possibly the next Prime Minister because he's so far advanced in the polls. What do you think?
Yeah, look, I like the fact that both the Conservative and the Labour governments are talking about pro-business, simpler regulations, getting more innovation in the country, becoming competitive, and we all need, like we all have too much debt. Growth is the best antidote for everything.
According to Chinese state media in geopolitics, China's President Xi said that Arab countries play a key role in stronger solidarity and cooperation for Global South, upholding common interests.
First rung in a ladder creates dignity, more household formation, and I think countries have to do more of that because if they don't, you can have a tough time.
But do you think the UK economy will change under Labour?
I don't know yet, but I was happy with what they were talking about. We had Rachel Reeves come to our conference too. That they're all talking from the playbook. We need growth, simpler regulations, more capital formation, more capital investment, meaning proper taxation, because that's the way to help our whole country and all our citizens. So that is what we should all be doing.
Jamie Dimon, we talk around, India all the time. Is this a decade for India, and does it somehow counterbalance China for, world growth?
Yeah, look, I think India has done a very good job. And when you look at India, yes, it should have a very bright future. I'm not saying it's a counter to China, but a very bright future. And I think we should all be reaching out to India. That they have to stay non-aligned because they're kind of where they are in the world between Russia and China. But they're a democracy. They're a natural friend of America and the Western world, and we should all be helping them. And they've made a lot of changes there, infrastructure. Transfer payments, 700 million people bank accounts that are going to be very good for that country.
So what does that mean for JP Morgan?
Well, we're not in the retail business there, but
will you be in the future?
We have 60,000 employees there. We got big campuses, high technology, and we're expanding our trading, our research, our investment banking. Yeah, we're there in a big time. Yeah.
Can you talk to me a little bit about JP Morgan and how, you've had a number of high-profile departures. How does that change actually the way you focus your business and how you run things going forward?
Not at all.
Nothing? Zero? If you were to buy anything, what would you buy?
Oh, that's different. Look, we can't buy banks. You do know that. So,
It's been 5 minutes time now at the bottom of the hour. See the release of the weekly initial jobless claims. Forecast 220k, prior 231k. Forecast range of 231k to 210k expected. Continued claims, forecast 1.78 million on the prior 1.785 million, with a range of 1.8 to 1.745 million expected. The US housing starts number, forecast 1.421 million on the prior 1.321 million, with a range of 1.49 to 1.328 million expected. The change is forecast at 7.6% on the prior minus 14.7%. US building permits number, forecast 1.48 million on the prior 1.467 million. The change forecast at 0.9% from the prior minus 3.7%. We also get the US Philly Fed Business Index, forecast is 8 on the prior 15.5. US import prices month over month, forecast 0.3% on the prior 0.4%. And the export prices month over month, forecast 0.2% on the prior 0.3%.
You'll probably be speaking to a fake diamond who's just answering questions.
An avatar?
An avatar, yeah.
Do you think about technology a lot?
Yes, all the time. Every meeting we have, this has been true my whole life, when we have any management meeting, your technology agenda is on the table. That includes AI, cloud, just more analytics. What are you doing to do things better, faster, quicker for clients? Digital. huge amount of digital services, integrating them better, automating them better.
But that would change. I mean, that will change, I guess, the heart of banking. Does that mean that you'll see more winners and losers because of the technological advancements?
So technology has always changed. The heart of banking, moving money, holding money, advising money, raising, that won't change. And you have to do that according to rules, laws, regulations by country. What'll change is how you deliver it. So like right now, you go on your phone and you can move money and buy stocks. That wasn't true 20 years ago. So yes, everything you do will change because of technology, but you'll still have to move money, budget, raise money, make investments, etc. So the core won't change.
But will it change?
And regulations may change that too, obviously. So
in the U.S., so again, would a Trump presidency be more favorable to banks when it comes to regulation?
I don't know. I mean, I am unhappy with the amount of rules and regulations coming out today. I don't know what a second administration of either one would do. I'm hopeful that they focus on growth, which is good for the citizens, which is good for the country. And I would help anyone I can to do that for my country. I'm quite patriotic about that. And I do think you need to
help. In terms of serving?
I think you need helping.
Oh, helping as the bank.
Yeah,
okay.
Exactly.
It's good to get that clear.
Exactly.
Okay, Jamie Dimon, thank you so much for joining us. That was, of course, the J.P. Morgan Chief Executive Officer. With that, I'm going to send it back to you, New York.
Hey, Francine, thank you. Just a fantastic 15 minutes sitting down with the CEO of Jamie Dimon, the brilliant Francine Lacqua, breaking down the markets there and everything else. I think what you heard there, it's really important to point out, that was not an economist giving you a base case, a strategist giving you a point target for year end. It was a chief executive talking about a very wide range of outcomes that he needs to manage wherever they fall.
What I find interesting is his range of outcomes still has skewed also to the idea of yields going higher, of inflation remaining
ECB's Villeroy says the probability of a June rate cut is significant.
6% or 7% or 8%. But how do businesses hedge against that possibility at a time where they have to be prepared for risks that really are maybe a little bit more unpredictable right now?
If you're a bank executive, these are things that you'd be worrying about. MH, also a lot in there about foreign policy and international risk too.
Yeah, interesting what he had to say about the U.S. and China can work together. That's the complete opposite of what we've been seeing, what potentially we will see, whether or not it's Trump or Biden next year. I mean, just this morning, the Wall Street Journal coming out.
1 minute remaining. I'll be leading with the U.S. initial jobless claims.
Chinese companies due to what they're calling forced labor and Uyghurs. We've continuously see time and time again, whether it's export controls, tariffs, sanctions. There's a lot of daylight between this relationship, but he says they're not necessarily natural enemies.
If you're just joining us and you missed that conversation, you want to go back over it, it will be on the Bloomberg terminal and on Bloomberg.com. Francine Lacqua sitting down with the JP Morgan CEO, Jamie Dimon. In about 50 seconds' time, we'll get jobless claims. So let's work through the financial markets and bring you the economic data. Equity futures going into it, just about positive by 1/10% on the S&P after closing at all-time highs in yesterday's session. On the NASDAQ 100, on a 5-day winning streak through Wednesday, this morning up by 0.15%. If you turn to the bond market, we've talked about the levels we've been to over the last month, through 5% at the front end of the curve on a 2-year, all the way back down to the 470s, 474 this morning, and up about 2 basis points. On a 10-year, Lisa, life in the 470s was only a few weeks ago. We're back down to the 430s.
222k, 222k, higher than forecast, 220k. The housing starts numbers, 1.36 million, 1.36 million. That's lower than forecast, 1.421 million. The US Philly Fed Business Index, 4.5, lower than forecast of 8. Import prices month over month at 0.9%, 0.9%, higher than forecast at 0.3%. Export prices at 0.5%, 0.5%, higher than forecast at 0.2%. Continued claims at 1.794 million, 1.794 million, higher than forecast 1.78 million. Building permits number at 1.44 million, 1.44 million, lower than forecast 1.48 million.
73. Lisa, if you were concerned about maybe a continued breakout in jobless claims.
Looking to the markets here, seeing some whipsawing in the S&P 500 and the dollar as well, following this slightly mixed bag of data.
That said, Constance Hunter made a really good point where she was saying we're seeing the end of labor hoarding. There seems to be a change in the dynamic to something maybe more normal. It isn't necessarily things wholesale shifting, but there is this creep higher in the sense that, remember when jobless claims always came in below expectations? That's shifting, right? I mean, it was
noting the prior revisions here as well. Initial claims revised up slightly to 232k from 231k, while continued claims revised down slightly to 1.781 million from 1.785 million. Housing starts revised down as well to 1.287 million from 1.321 million, and the building permits was revised up slightly to 1.485 million from 1.458 million.
Part of the problem is, and I keep going back to this, it's so confusing because there's so many different populations. There are different labor markets that are kind of overlapping. There are different consumers. We were talking about that K-shaped recovery, and it's getting that much more difficult for the lower income tier. We're seeing even the upper income tier with Walmart go down the income spectrum. At what point is there consistency in the reads across some of the data that we can get a narrative that actually sticks?
A ton of economic data in front of me right now, but the highlight, jobless claims 222, the estimate 220, the previous week a revised 232. With us around the table, Michelle Maher of the MasterCard Economics Institute and Colin Martin of Charles Schwab. Michelle, first to you. What do you make of that economic data? And let's sort of fold it into yesterday as well. What do we take away this week?
Well, I think it shows that the economy is evolving as it should be as this business cycle matures. So initial jobless claims still very, very low. Little to no evidence of challenges in the labor market. If you look at the 6-month moving average for job creation, we're running at about 250,000 jobs per month. You have more labor force engagement. You certainly have the support from the labor market. On the inflation side, I do think you're seeing potentially some moderation, certainly in the goods side, less on the services side. But it's part of what you would be expecting to see as this cycle evolves, where the goods economy kind of overinflated and now it's correcting. The services economy is still seeing a lot of momentum and strength.
One piece of the data puzzle we didn't touch on just then, retail sales. How much weight would you put on that weak print yesterday?
I don't think it's that important on a month-to-month basis. It follows off of very strong retail sales numbers earlier in the quarter in Q1. So if you look at the trend for consumer spending,
that's the US Treasury 10-year yields, little change following the data as well.
To Q1 GDP, if you look at real consumer spending tracking for Q2 from the Atlanta Fed measure, we're running at about 2.5% on an annualized basis in real terms. That's still
I posted out the Philly Fed Business Outlook May report, the import and export April report, and the housing starts April report on the feed for anyone interested.
Not necessarily falling off a cliff.
Yeah, I think so. When we look at the data, we see things slowing, but it's cooling but not cool. And we're not expecting things to fall off a cliff right now. If we look at the inflation front, I think it's a step in the right direction. But if we still want to look at the actual numbers, and CPI, obviously we're going to focus more on PCE, but with CPI, 3.6%, 3.5% area year over year, that's still a little too high. And 0.3%, it was an improvement from the first quarter, but that's still elevated if you look at it from an annualized basis.
We were talking earlier about how no one shifted their views after yesterday's data, and it seems like no one's shifting their views in general, and everyone's just sort of entrenched with whether we've nailed this soft landing or whether we're heading toward Armageddon or whatever you want to say. I'm just wondering, it seems like the market's weighing in, and it's just basically celebrating the victory of the soft landing. Colin, would you weigh in and basically say, yeah, let's celebrate?
We're not celebrating just yet. We try not to get too tied up with every single release, because we do have more of a long-term view when we're providing our guidance. It's a step in the right direction. We have not changed our views. Coming into the year, we expected 3 cuts. We shifted it to 1 to 2. Yesterday's report, again, good news, but that's not getting us back to the 3-cut area right now. So we're still comfortable with 1 to 2 right now.
What's the date for that first one? July, September? What are you looking at?
I'd say September. I saw a comment about July, and that just seems too early right now, given what we saw in the first quarter.
We get another CPI print in the middle of June, same day as the June meeting, another one in July. Back end of July, you get a Fed meeting. Is July still too soon?
I think it's in play. I think at this point, the Fed has made it very clear they are monitoring the data. They're looking at financial conditions. They want to understand the evolution of the economy. And they're not talking about cutting interest rates because there's a significant problem in the economy. They're talking about normalizing monetary policy. And I do think that's an important distinction when you think about what are the triggers to get them to start shifting the interest rate environment.
Let's run with that word. They're talking about normalizing without talking about what normal might be.
Fair, yes.
Okay, so what is normal going to be in this regime, and why aren't they talking about it?
I think they don't know. They don't know what those star variables are. But it does seem like the commentary is that they're probably higher than they had previously thought, right? That the star variables are likely a bit higher, that we're probably going to be in a higher for longer rate environment, maybe a little bit stickier, higher inflation, a little bit, maybe higher potential growth rates, at least for now. And that's going to influence as well how they think about the timing of the cycle.
You put out data that I thought was fascinating. A record high, 15.9 million Americans traveled internationally in the first quarter. Cruise liners are going bananas.
Yes.
You have people basically spending, incredible amounts every day on experiences and going, jet skiing and going bungee jumping. And there's this question of, okay, well, how much does a Fed cutting rates now basically give a gift to people who are invested in this market, can really benefit from the upswing and not fight the inflation that's causing people at Walmart to really be selective?
Look, I think when you think about what's happening in the travel economy, it is super meaningful. Those stats that you just referenced in the report we just put out in the Economics Institute of MasterCard is huge. I mean, this is a sector that is seeing extraordinary growth in terms of the number of people who are traveling, the different destinations that they're trying to embrace, the intention that they have in terms of choosing where they're going based off of what they're seeing for currencies, what they're seeing for affordability, for new and interesting places to visit that they haven't been. There's a lot of demand out there to have these types of experiences, and travel is the #1 experience. And the fact that you're seeing this type of growth tells us that the consumer has purchasing power. The consumer is still active, and the labor market is still very much supportive in that regard. So I think for the Fed, they have to look at the big picture. They have to look at total spending, but then try to understand what's happening in terms of the moving parts within that.
So, Colin, if I take a look at, for example, a hotel that cost me $200 2 years ago, and now I'm looking at $400 with what John would say would be fewer services, I'm wondering, how is this not inflationary, given the fact that people are willing to spend, who are in a cohort who have money to spend, even at a time where there's an increasing cohort of people struggling under the weight of inflation?
Well, I think it goes back to the sticky point right there. But if we look at what does the outlook look like going forward, is there going to be a reacceleration right there? Because I think the idea of excess savings, I think we can put that behind us right now. It's not something I really think about too much. I look at the labor market, as we've talked about, still strong but cooling. We're seeing wages still grow. Until we see more of a sharp fall off, we'll probably continue to see spending remain high, but we are seeing some worrying signs out there. I think Michelle probably has more data than I do, but on the consumer credit side of the equation, we are starting to see those delinquencies turn up a little bit. We're seeing more and more credit, although the pace has slowed down a little bit. That's something that we're paying attention to, because if we're using more and more credit in a high rate environment, we think that over time that should slow things down.
Just for the record on the hotels room, what I don't like, and other people agree with me, is when they sort of say they're going green, so they're not going to do the laundry, unless you really want a clean towel, in which case leave it on the bathroom floor. That's what annoys me.
Okay.
You've spent a significant amount of money to stay in a decent hotel, and then they want to sort of like pressure you into this sort of moral conundrum. Do you have a clean towel?
I'm sorry.
He also doesn't
Or
like
do you
hotel
save the
points.
planet?
You have to have
clean towel.
There are 15 towels underneath the sink usually. Do you use every single one of them?
Sometimes I use a lot of towels.
Well, that's an image that I really
Sometimes I use a lot of towels. And you want a clean towel.
Yeah, you want it
You stay in
consistently.
a hotel, 2 showers a day. Why not?
Okay.
You paid for it.
Why not 5?
What a conundrum. Clean towels, save the planet. It's tough, right? Michelle, we won't talk about that. Let's talk about the economic data. You don't want to talk about that. Delinquencies. Is that normalizing, or is that something to worry about? What's happening around those kind of themes? People struggling with debt.
So if you look at the New York Fed survey that came out this week, which I think is probably the most comprehensive measure of what's happening in the state of household balance sheets, you have seen continued move up in delinquency rates just above where they were prior to the pandemic. So it's still part of this kind of normalization process. And I think it's partly a function of the fact that interest rates are higher, which is part of what the Fed was intending to do. By increasing interest rates in an environment where the economy was very, very hot, the goal was to cool down the economy, prevent inflation from becoming unhinged, make sure that we can continue to see the economy grow closer to trend for a longer period of time. So I think it's part of what's playing out in a high rate environment, as Colin noted it as well.
We were all seduced by this idea because this is the outcome we want. We wanted to be able to get inflation back down to 2% without the pain, the pain that Chairman Powell talked about in Jackson Hole in August 2022. It feels like we've got so far without the pain, got to about 3.
Yeah.
Do you think we can get back down to 2 without the pain?
I think we're on path to do that. I also think there's a question of, do we have to be right at 2%? for them to feel like they've achieved what needs to be achieved and to feel as though we've reached equilibrium. The Fed and central banks broadly have always talked about this idea of a range around the target. And for a period of time, post-financial crisis, inflation was running significantly below target, which led to this discussion around asymmetry. And now inflation is running a bit above. So as long as there's a belief that long-term inflation expectations are well anchored, which they'd be relying on surveys for, I think that, as long as we're in that range of 2% inflation, I think that is probably quite acceptable.
This is what David Kelly was talking about yesterday, and how maybe the Fed needs to look at what Canada's doing, look for a range of 1 to 3%. What do you make of that? Do you think they should be targeting a range, not be obsessed with that 2% target?
I don't want to get into what their policy will be, but I think I'll piggyback on Michelle's points about what they're probably looking for. They don't need to see 2%. They've told us they want to see it moving down towards 2%. They don't need to wait for a magic number before they start to cut. We think that will probably come soon, but what's important, I want to go back to another point of Michelle's about what is normal. I think in this environment, given that the economy has remained resilient, given that things are going pretty well, when they do start to cut, it's likely not going to be because they need to save the economy or something like that. It's more just bringing it down so real rates don't get too restrictive. But what we're trying to figure out is, well, what is that ultimate landing place? Because that has implications for all parts of the yield curve.
Well, Neil Kashkari talked about that yesterday and said maybe they're not restrictive enough and we should be putting 2 feet on the pedal in terms of the brakes. Do you think that actually they're not restrictive enough and they might just want to hold for even throughout the entire year, not wait till 2025?
It's possible, but I don't necessarily agree with Kashkari's points. He's been saying that for a while. I think he's in the minority. It seems like there's enough officials out there, Powell included, that think it is restrictive. But I think there's a difference between Fed policy and then actual financial conditions. And when we continue to see stocks rise, credit spreads stay low, when you look at it from that point, from a wealth effect, maybe things aren't as tight as some might think.
And here's the psychology portion of the Thursday morning.
Oh, Therapy
Michelle,
Thursday.
Therapy Thursday, as people try to grapple with, am I getting too sanguine on this soft landing? We hear it. There's sort of an angst about being with this consensus and this sort of hopeful feeling. Michelle, do you feel that with your colleagues, that sort of people feel like things are okay, but they feel reluctant to say it because it kind of feels wrong to lean into kind of the consensus and where we're at?
Well, I don't know. I mean, I think for me in the institute, we've been pretty optimistic for a while. I'm feeling pretty comfortable with that.
Well, there you go.
Maybe I'm
take a victory lap.
But I think that people are careful because this is a very different business cycle, right? It was a business cycle that was spurred by one of the largest external shocks that we've seen in a very long time, which was the pandemic, and so much has transformed in the economy since then that I think people are trying to figure out how much are cyclical changes, how much are structural changes in the economy, where do we ultimately settle, back to this conversation around these trend variables. But I do think that examining the real-time data has very much led us in the belief that it's an economy that still has room to grow, and we feel comfortable with that.
Well, and Colin, from your perspective, you still like duration. You're saying you have an opportunity, keep going, which feels comfortable if you look at history and you think, okay, we're going back down. Do you still have that conviction, and is it ever difficult to just stick with it?
We still have that conviction. We've had it for a while now. We're probably at 12 to 18 months where we've been suggesting that. The good news is, if you're an investor or a Schwab client and you haven't yet, you still have the opportunity. I mean, we're not at the highs of this year, but we still have that conviction because we don't expect yields to rise much further from here. In order to get, say, the 10-year, for example, to get back to that 5% level, we think we need to see really that reacceleration in growth and inflation, and then the expectations for Fed policy to shift from either not just higher for longer or cuts, but actually to a hike. And we just don't see that happening.
What happened to this idea of the industrial policy being inflationary, this idea that tariffs would be inflationary, that people spending their baby boomer money would be inflationary? What happened to all of that seems to have suddenly been forgotten, or not forgotten, but dismissed by, this is a new era, we're good, it's not going to be like that?
Well, things are going well, so maybe it's just kind of the psychology aspect, and if you see your balances going up, and if you can handle that, if you locked in a low mortgage rate, maybe things are looking pretty good. But we're still holding the line that we think over time we're going to see those long and variable lags, and that the longer the Fed holds at these rates, it should slow things down. One thing we are looking at is how this impacts the credit markets, especially where we can see some cracks is maybe in the junk part of the market. Higher for longer should hurt them more because they're more sensitive to high rates.
Michelle?
Well, I think what you raised around how do we think about these bigger issues impacting inflation, I think they are all impacting inflation, right? It's difficult to understand exactly why we're at this stickier inflation environment, right? You do know that, yes, in the pandemic, when it first occurred, supply chains were distorted. You had this big cost push and goods prices set higher. And they're starting to correct, but if you look at the level of a lot of goods prices, it's still significantly above where it was prior to the pandemic. So is that still the pandemic hangover, or is it some of the factors that you suggested, which are a little bit longer term in nature? So it goes back to this idea of, will we have a bit stickier inflation? Will we have a little bit higher for longer interest rates, as Colin was just talking about?
And this is what Jamie Dimon was talking about with Francine about 20 minutes ago as well. Michelle, thank you. Going to leave it there. Michelle Mather of the MasterCard Economics Institute, alongside Colin Martin of Charles Schwab. Colin, thank you to you as well. If you are just joining us, welcome to the programme. Moments ago, we had jobless claims in America coming at 222. The estimate was 220. The previous week was a revised 232, so a little bit lower on the week at least. Equity futures still just about positive by 0.1% on the S&P 500. Going into the opening bell about 44 minutes away. If you check out the bond market, yields climbing higher just a little bit, creeping higher by 3 basis points at the front end of the curve. The 2-year just below 476 on a 10-year yield this morning, just about unchanged at 434. And to check it on the euro, the dollar absolutely slammed yesterday against G10, taking some of that back this morning against G10 again. Against the euro, 108.65. We're negative on that currency pair by 0.2%. Colin, Lisa talking about cooling but not cool, and Andrew Hollenhorst of Citi talking about slowing but I guess not slow. The US economy is finally slowing down, with job growth decelerating, consumer spending on goods declining, and looking for that first rate cut, over at Citi at least, to come in July.
What did Matt Miskin say? We're all sunning in the glory of a soft landing sun, and that seems to be where everyone's at, essentially just basically threading this needle perfectly as everyone dances on the head of a pin.
A soft landing island, I think he called it. Soft landing
Thank
island.
You. I knew I was not getting it totally right. It was much better
for this
than
summer.
that. Yeah.
And Bramo baited me with that hotel point because you know I was going to buy.
I knew.
You know I was going to buy. Okay.
You're welcome.
Let's get an update on stories elsewhere this morning. I'm not sure the audience feels the same way. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bridgewater founder Ray Dalio told the FT that he's concerned about U.S. markets and the growing geopolitical tension. He said that rising U.S. debt levels could impact the Treasury market and that the risk of another international conflict could reduce foreign demand for Treasuries. The billionaire said that while the best parts of the U.S. are still the best parts for the world and for capitalism and innovation, that investors should look to move some of their money elsewhere. Senator Bob Menendez is blaming his wife Nadine for gold bars seized in their home by the FBI. The New Jersey politician is currently on trial for corruption. Prosecutors allege that Menendez is at the center of a multifaceted scheme that involves bribery and acting as a foreign agent. The senator's defense attorney pushed back on claims that he took those gold bars and cash and a luxury car from 2 businessmen in exchange for favors, instead telling jurors that the gold in particular was given to his wife without the senator's knowledge. And Netflix will be airing 2 NFL games on Christmas Day. It's, again, the streaming giant's push into sports. The company signed a 3-year deal with the league, which will see at least 1 Christmas game on Netflix in 2025 and 2026. But it also just adds 1 more platform you need to watch the NFL games. They are set to stream this season across Netflix, ESPN+, Peacock, Amazon Prime, and YouTube's Sunday Ticket. And that's your Bloomberg Brief. John.
Messy. Danny, thank you. We've got so many things to say about this, so much to say, but here's another point. If you don't know where to find the sport, I don't think it's good for the sport. I see this in other sports as well. I've settled down a little bit with Premier League football in this country at the moment, but when it went to Peacock, which games were on Peacock? Which games aren't on Peacock? When you have to sit there on a Saturday or a Sunday trying to find the game, that's not good for the sport. And
if you're a kid who gets all of your television off of YouTube and you can't find it there, are you going to be the fan for those teams?
Exactly.
Seriously.
I think it's a real problem. It's not good for the sport at all, especially at a time when NFL is doing so well at the moment in this country.
Capitalize on it.
There you go.
Bring Taylor in.
Get Taylor in and do a special on Netflix. Is that what you'd like? Okay. All right. That annoys a lot of people, you know.
I do.
There's like 2 camps that don't care and other people who really do care.
Yeah, well,
very fired up about it.
Ray Dalio is a Swiftie, so,
Didn't know that.
Yeah.
Mohammed Al-Arian too.
Yeah,
We mentioned
he even
Mohammed.
thinks she can run for president, Ray Dalio.
Is that what Ray thinks?
Yeah.
Why? Does he actually think that?
She
In 10 minutes' time now at the top of the hour, we expect comments from Germany's Finance Minister Linda.
What does it say about the state of politics in this country that we're talking about pop stars uniting the country and running for office?
Exactly what it should say about 2024.
And not good. Up next on this programme, setting you up up for the day ahead. You're watching Bloomberg Surveillance.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern. Only on Bloomberg TV and radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Barry Knapp, thank you for the support. You and I share all the same problems: airports, where to watch football, and I even empathise with your hotel issues as well. Thank you, Barry. And for the other people that reached out in the last 10 minutes, all 3 of you, I appreciate it. Equities right now just about unchanged on the S&P 500. Yields higher by a single basis point on a 10-year, 434.97. On our radar, about 40 minutes away from the opening bell, the data-dependent Fed.
We're not celebrating just yet. We try not to get too tied up with every single release because we do have more of a long-term view when we're providing our guides. It's a step in the right direction. We have not changed our views. Yesterday's report, again, good news, but that's not getting us back to the free cut area right now. So we're still comfortable with 1 to 2 right now.
So here's the trading diary for the next 24 hours or so. Chipmaker Applied Materials reporting earnings after the closing bell. The Fed speak lineup is absolutely stacked. You'll hear from Barr, Barkin, Harker, Mester and Bostic ahead of Waller to round out the week going into the weekend. And Boeing holding its annual shareholder meeting at 11 a.m. tomorrow. If the regulator can't regulate Boeing, can the shareholder? We'll find out, I guess, a little bit in the next 24 hours. Bramo, final thoughts?
Well, just this idea of soft landing island, that seems to be the takeaway. My takeaway is nothing's changed from the economic data this week. So it really goes till next Wednesday and NVIDIA reporting earnings that really becomes the next big stopping point at a time when a lot of people are looking at the shifting sands of technological shifts, et cetera, that might create something new that some of the economic data just really hasn't. This economy just keeps chugging along.
And there's lots of concerns around the economic data. Are people picking up the phones and some of them? Is it coming out on time? The revisions, look at PPI, how strong those revisions were. So when you look at potentially maybe what corporates are saying, Walmart this morning I thought was great. This is one of the biggest companies in the United States and showing that the higher end consumer is looking for deals. Inflation is biting everyone across the board. And that for me was the big point.
What do we think of Jamie in the last hour? What was your big takeaway from that one, Lisa?
He is the ultimate politician, even though he doesn't want to be in politics. I mean, this is essentially, he said he's not interested. But at a certain point, the corporate executives, to me, are becoming the new ambassadors for the United States in a way that a lot of politicians in the U.S. aren't. And I find that the most interesting in some of these international tours that we hear from a lot of chief executives.
Absolutely. We saw that in Davos. Remember, it was him behind the scenes with Zelensky having this catch-up, him and a number of other executives. But what job, if he was
So
a politician,
just less than
would he
5 minutes away now.
applying
What do we expect to hear comments from
Francine, of
Germany's
course, as the
Finance
Treasury
Minister, Linda
Secretary, which
speaking.
even in Washington, D.C.
State Department.
I was there last week, and his name was brought up again as someone who potentially be Treasury Secretary. But then he talks about nuclear blackmail, China not a natural enemy, talking about India. I felt like he was going over to the State Department, the Defense Secretary.
Take a pick.
Well, I think at this point, this is somebody who can have that sort of bird's eye view, and will have that bird's eye view. There is this issue of who is going to fill the White House, and we talked about that with Libby Cantrell, and I will just say that corridor between Washington, D.C. and New York has gotten very busy. And
Yeah.
you can feel it as people try to kind of gun for different
I'm not sure it's Wall Street, it's the court downtown. It's not Wall Street and DC in that corridor that's got
what you
busy.
think?
You come up here to kiss the ring. That's
Speaker
what's happened the
Johnson.
last couple of days.
Yeah.
Absolutely, yes.
It's quite the lineup.
Absolutely. Coming up tomorrow, here's your lineup tomorrow morning. Jeff Yu of BNY Mellon, Megan Robson of BNP Paribas, Mohammed Al-Erin of Queen's College, Cambridge, and Morgan Stanley's Seth Carpenter. All of that and more from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
October of 2019, you surprised the business world by stepping down as the CEO of SAP, a very, very large company whose value had more than doubled during your co-CEO position and CEO position. And you took a position with a much smaller, less known company, ServiceNow. Usually people, when they leave a job, they go to a bigger company. Why did you go to a smaller company?
Well, I saw the future and where it was going. First of all, I want to say I had a great run at SAP, and it was a pleasure taking them from 39 billion to 163 and really inspiring lots of people and customers, and it was a wonderful experience. But after 17 years, nearly 10 as CEO, I was ready to do something different. And when I saw ServiceNow in the marketplace, I knew what it was, and I knew what it could do. And I knew with my background, I was a pretty good cultural fit for what ServiceNow needed to scale it.
So let me ask you, what does ServiceNow really do? Tell me in simple English language that everybody can understand. What do they actually do?
40% of the CEOs say today, if I don't digitize my operations, my company will no longer be viable in less than a decade. So we were the IT backbone for companies all over the world. How do they manage their assets, run their operations, secure their operations, all things digital having to do with IT.
Season 2 of The Circuit. We're walking with the titans of banking.
You guys love these meet and greet things.
me
like, how are you?
And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass. That's what I'm going for, like badass soccer mom.
I'm Emily Chang.
Effective Fed funds rate 5.33% for May the 15th, unchanged from May the 14th.
Host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
This is Bloomberg.
Live from New York City for our viewers worldwide, I'm Matt Miller. A slew of economic data this morning doing nothing for markets. We're seeing very little movement after we hit an all-time record on the S&P yesterday. The countdown to the open starts right now. Coming up, stocks sitting at record highs with Fed speak in focus.
We have a mixed bag of economic data doing little to move the needle, and Walmart delivering a beat thanks to price-conscious consumers. Let's start with the big issue, mounting signs of Goldilocks.
Retail sales have been cooler. The labor market looks to be moderating. Perhaps more consumers are
So
heading
Germany
to more
expects
market
11 billion euros less federal tax revenues next year, expects 5.6 billion euros less federal tax revenue this year. Tax estimates show there's no room for more spending, according to Germany's Finance Minister Linda.
We don't see it yet.
Joining us to discuss now is Morgan Stanley's Caterina Simonetti, as well as Richard Bernstein of RB Advisors. I think we still have to talk a little bit about yesterday's data, not yet today's. Katerina, what do you make of the perceived slowdown in inflation, or I guess the actual data slowdown, although it's only obviously one data point?
Well, Matt, we will take any good news we can get. And of course, Fed is so focused on inflation, and we appreciate the fact that this is a move in the right direction, but we're nowhere close to their target rate of 2%. So what this tells us that they're very much still staying the course. We most likely are going to get few rate cuts this year, but the timing of it, that's really the question, because it's a data-driven Fed. They're going to look at the numbers, and as much as we appreciate the decline in the CPI, it was just marginally lower, and we would love to see, a better numbers. And I think Fed, is looking very closely at this before they take an action.
Richard, what do you think? I mean, encouraging, I think, is the way you described it in your note. Obviously, we've had other consumer confidence, labor data that hasn't been great. How do you see the Fed's position right now?
So Matt, I think the interesting point is in your preamble to this segment, there was a whole discussion about the soft landing, and I think economists continue to use the word landing and just refuse to consider that maybe the economy isn't landing, that the nominal economy is actually still strengthening. I mean, corporate profits growth is still revving up. You've had, inflation today. Yesterday we had an encouraging number, but today we had a discouraging number with import prices. The core import prices are up year on year now for the first time in, I think, 14 months. So I think there's still a chance that the economy isn't landing, that we're still in the process of accelerating to some extent.
But we have had, we have had earnings numbers, I think, that support that argument, Richard. 3 quarters in a row of earnings expansion after contraction for the previous 3 quarters. How does it look to you from a stock market perspective? I mean, we've already had a really decent run yesterday at an all-time high on the S&P.
Right. So Matt, I think the mistake that people can make right now is thinking about the market and thinking that there's one market out there, when in fact the market remains very bifurcated, where we've got sort of the Magnificent Seven, Fabulous Five, whatever it is, and then you've got almost everything else in the global equity markets. And I think the story that I think is the real investment story, the exciting investment story that's out there is the broadening of profits growth, the broadening of the markets. I mean, in the United States right now, there are over 170 companies growing, or just in the S&P 500, growing earnings 25% or more. So is there anything unique about the Magnificent Seven? That's the question I think every investor should be asking. And about the U.S., right? I think it's important that you mention that because we see investors now looking for outperformance in other regions. Katerina, are your clients, looking to move out of the U.S. and rebalance a little bit internationally?
Matt, not so much, but I agree with Richard that as we decipher the earnings, it's really important to realize that some companies, especially the smaller ones, are really struggling in the higher interest rate environment and inflation that is affecting the margins. And others are seemingly very effective controlling their costs and staying profitable by cutting costs and being very frugal in the way they operate their businesses. But then there are also companies that are thriving because they're competitively positioned and there is a strong demand for their products. So we see the opportunity not so
In 10 minutes time now at 9:15 a.m. Eastern Time, we get the US industrial production data month over month. Forecast is 0.1% from the prior 0.4%, with a range of 0.4 to minus 0.3% expected. Capacity utilization forecast at 78.4% on the prior 78.4%. Manufacturing outputs month over month forecast 0.1%, prior 0.5%. Industrial production year over year saw a prior flat rate of 0%.
Environment in the long run.
All right, so let's get back to that in a moment. Talk about stocks specifically, talk about sectors. Right now, though, I want to get to the economic data quickly because there was a lot out this morning, and Fed speak continues to roll out as well. Here's the latest from Minneapolis Fed President Neil Kashkari.
How much downward pressure is monetary policy putting on the economy? That's an unknown. We don't know for sure. And that tells me we probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.
Bloomberg's Liz McCormick joins us now for more. And Liz, we've had, days of economic data that we're all watching today, a full page on EcoGo and more Fed speak. What do you make of the positioning right now of the FOMC?
Yeah, I think like Neil Kashkari was saying, many of them are signaling what the best policy is now is just to wait, right? They think they're restrictive, but they're not quite sure. It's kind of like do no harm is waiting. But the market is pretty much priced for that they'll cut twice. In the March dot plot, the Fed signaled, but it was an uber close call. The median was for 3 cuts, and I think the market believes that the next update in June will show 2. But like we have Loretta Mester speaking later today, and last month she had in an interview that she said she was at 3 cuts, but it was a close call. So, I think we're really watching, to see how much more hawkish the tone of the Fed speakers sound. But I don't think the market's willing to go too far over its skis yet because, we're kind of priced to perfection in a sense. 2 cuts seems reasonable. I know Bloomberg Economics says July is still a possibility. That's their call. We're very low odds for that. Most of the pricing is for the first cut to come in September. But yeah, we had a plethora of data today. It didn't kind of move the needle too much either way, but CPI, as we know, helped a little. So we're still in kind of wait and see mode.
Richard Tang over at Rocco says there's not going to be any cuts. And I have to chuckle at someone forecasting a move by the Fed in September, right? 2 months before a presidential election seems like something they wouldn't do. How can they move? Aren't their hands tied ahead of the, big political event?
Yeah, now, of course, Matt, Chairman Powell was asked that specifically at the last press conference, and as is his job, he said, no, we'll do whatever. But I think you're right. There's a lot of people calling it this jump risk. I think the folks at Bank of America said that if they don't get one in too soon, you're right, that September, of course, November is just not a good time. That's why, there's a decent amount of forecasters saying 1 cut this year in December. So I think you're right. Fed doesn't want to say, politics ever factors in, but it does get stickier as the election gets close. So, we have to see. I don't think, I remember talking to Richard Tang years ago. He's been at a few shops. There's many who say we might get nothing this year, right? And the Fed, waiting, let's see how it goes. They could be waiting and waiting and waiting, right? So, that's not impossible that there's none that come through.
Yeah, all right, Liz, thanks so much for joining us. Liz McCormick there talking to us about the Fed. I want to kind of get away from the parlor game of what are they going to do and talk about, Richard and Katerina, you both bring up, what companies are doing. But you can't obviously divorce yourself completely with whether or not Fed policy is restrictive. Do you see it that way, Katerina? Because certainly asset prices haven't been held back by Fed policy. What about companies' behavior?
Well, certainly we cannot divest ourselves from the news, especially that, given that this is all we're talking about. And investors are troubled by the uncertainty that all of this brings. And, they can't help but question what it means for their portfolio. And in our view, the biggest concern on the portfolio level is this unintended concentration that the performance of last year, and especially the Magnificent Seven, is bringing, because some companies, especially the large ones, are seemingly unfazed by the high interest rate environment. And some
investors are finding themselves being concentrated in those names, and we can't forget that even
It's been 5 minutes time now at 9:15 a.m. Eastern Time. We get the US industrial production month over month. Forecast to 0.1% on the prior 0.4%, with a range of 0.4 to minus 0.3% expected. Capacity utilization forecast at 78.4% on the prior 78.4%. Manufacturing output month over month forecast 0.1% on the prior 0.5%. The industrial production year over year saw a prior flat read of 0%.
Other sectors, are they undervalued?
Oh, Matt, I think it's pretty easy to make the argument that most of the global equity market is actually quite cheap. That doesn't necessarily mean anything unless earnings are starting to accelerate. And I think that was my point before, that earnings are starting to accelerate. You know, value investors always want a catalyst. The catalyst is there. The question everybody should be asking, and this is something that Katerina sort of alluded to before, why isn't the market reacting the way it normally would? And the answer is, I think economists have completely missed the boat on this one in saying that the Fed is so restrictive. If the Fed is restrictive, since I'm on Bloomberg, why is the Bloomberg Financial Conditions Index showing that despite raising rates 500 plus basis points, financial conditions have eased? That's not supposed to happen. We see this every day. We see it in the meme stocks, tons of liquidity. We see it in the junk bond market. Spreads are very narrow. Institutional and financial advisors are daily being offered tons of private debt deals. Where is this tightening of financial conditions that would argue that the Fed has tightened too much and should be easing? I would argue it's the exact opposite, that despite 525 basis points, they haven't tightened enough to get financial conditions to tighten to meaningfully affect the economy.
It's easy to make that argument. I wonder if it's being made inside the Fed. Of course, Powell, continues to say that policy is restrictive, but do you think there's a chance, Richard, for another rate hike?
I don't want to overplay my hand here because of some of the issues you were talking about before with the election, and they don't want to appear political in any way. Right. So it's not that there's that, but I think if you want to take a long shot bet, and I emphasize long shot bet, I don't think anybody should use this as a baseline. Maybe the Fed's going to have to start tightening again. Maybe that's in early 25.
What do you do baseline after the run-ups that we've had, Richard? I mean, if you have new money coming into this market, how much of it do you put to work in stocks after, a 10+% gain year to date?
Well, I think to Katerina's point before, I think if you put it into stocks, Matt, using your word, and you put it into an index fund, I think you're going to be very, very disappointed. Not only over the next year and a half, you could be disappointed for a decade. We could have another lost decade in equities because the index is so dominated by these large cap companies, these 7 large cap companies. However, if you're on the other side of the seesaw, so to speak, if you think of that analogy, I think the next 1, 3, 5, 10 years could be very, very rewarding, but everybody's loaded up on the 7 companies thinking that AI is the wave of the future. We have to be there, everything else, and ignoring the breadth of opportunities in all these other sectors and industries.
Katerina, what's your take on if I give you new money to put into this market? Obviously we've run pretty far, pretty fast. On the other hand, people like Brian Belsky from BMO, who just raised his target on the S&P to 5,600, say momentum is hard to ignore.
Well, absolutely. I cannot agree more. And what we do not want to do is stay on the sidelines, because as comfortable as 5% yields in the money markets are, we have to remember that just a little bit over a year ago, we were looking at 1/10 of 1%. And
1 minute remaining. I'll lead with the US industrial production month over month.
Stock market. Now, we absolutely favor quality. We favor large over small. We tell investors to expand their time horizons and have realistic expectations and stay true to their asset allocation. But this market might deliver returns that are not quite exciting as we have seen in the past, because inflation is here, higher interest rates are here, and they might be here to stay for extended time horizon. But there is still more of an opportunity to be profitable, on the side of the stock market than remaining on the sidelines and missing this. There is volatility, but there is also opportunities on the especially on the single stock names.
Keep in mind the numbers on the Financial Juice website are reported in error. Numbers coming now in 10
Thanks so
seconds.
much for joining us. Katerina Simonetti there, as well as Richard Bernstein talking to us just 15 minutes ahead of the open today. Of course, we're already at an all-time high on the S&P 500, and let's get a look at what stocks are moving, which individual single stocks
0%, 0%, that's lower than forecast, 0.1%. The capacity utilization, 78.4%, 78.4% as expected. Manufacturing output month over month at minus 0.3%, minus 0.3%, lower than forecast, 0.1%.
3.8% jump in same-store sales. They also boosted the full-year outlook just slightly, and it looks like wealthier shoppers are going to Walmart, really looking for essentials and discounts. Chubb also up sharply, up 6.9%. A bit of a mystery has been solved as Warren Buffett's Berkshire Hathaway was able to reveal a $6.7 billion stake in the insurer. It had been hidden before. The SEC had not forced them to reveal that, but now we do know that that is their stake there. And then Deere, the odd stock out, at least on this board, down 5%. They cut their annual profit outlook, and apparently, Matt, farmer demand is slowing the most since 2006. It's expected to be down 26% this year.
Yeah, income, farmer net income down 26%, the biggest drop in like 2 decades. It's a huge delta, and I think, you know, such a fascinating story for Deere, but obviously Walmart as well. Everyone pays very close attention. Abigail, thanks very much for that. Coming up, we're going to hear from another person that people pay very close attention to. JP Morgan CEO Jamie Dimon speaking with us with Bloomberg at the bank's annual Global Markets Conference in Paris. We'll give you part of that next. This is Bloomberg.
According to a poll, the UK economy is to expand 0.5% this year, 1.2% next year, which is up from the 0.4% seen in the last poll for this year and the 1.2% seen in the April poll for next year. Inflation to average 2.4% in 2024 and 2.2% in 2025, which is down this year from the prior poll, which saw 2.5%.
On season 2 of The Circuit, we're walking with the titans of banking.
You guys love these meetings. Yes.
The German finance minister says the 2025 budget remains a major challenge. The gap to be closed is in low double-digit billion euro range.
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass. That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
The JP Morgan Annual Global Markets Conference is underway in Paris. The CEO, Jamie Dimon, sat down with our very own Francine Lacroix.
I wouldn't call it turbulence. We've had good, healthy markets for quite a while. They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets which are kind of wide open. That's all good. It doesn't tell you what the future is going to be. I mean, I can point a lot of times in history where that was true, and the next year it wasn't true, and so We'll see. I don't pay as much attention to monthly numbers as most people do.
I know. So what do you think the future is for inflation and interest
rates? I'm a little more worried about it. I mean, we've had very big fiscal deficits. And, I think the underlying inflation may not go away the way people expect it to. And I look at the future, like a lot of things we look at are kind of inflationary. The green economy, the remilitarization of the world, the infrastructure requirements, the restructuring of trade, fiscal deficits. So I think there are a lot of inflationary forces in front of us that, may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation a little bit higher, and maybe that'll slow growth. And obviously geopolitics is a whole different issue. That could be determinative in what our economy does next year. And we're just not going to know.
But so does that mean you think it's 50-50 whether the Fed cuts or hikes next time around, the next move?
I really don't pay that much attention to that. The Fed will have to follow the data, and I don't know what the data is going to say, but I think they are doing the right thing to be patient right now. See what's going to happen. They may not know for a couple of months.
But no big correction. I mean, if you don't pay that much attention to it, it means you're not worried about anything.
No, I'm worried. I just said stocks are very high, and I think the chance of inflation staying high or rates going up are higher than other people think. So I think the chance, my view is whatever the world is pricing in for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
In the U.S. or globally?
Well, I'd say in the U.S., but also that could affect globally, yeah.
And so what does that mean for markets?
They'd be down. And credit spreads would gap out.
So why is the market not pricing that in?
A lot of happy talk.
Where does that happy talk come from?
Low rates, central banks are going to reduce rates. Maybe the geopolitical things disseminate, don't cause problems. And so, the future isn't predictable like that. So, I'm a student of history. I've watched all the inflection points. If you go back, my dad was a stockbroker. I go back to the booming markets of 72 and the collapse of 74. The healthy markets of 80, the collapse of 82. The 87 market crash, the 1990 real estate crash, and almost all of them were not predicted the year before. So I look at these factors that drive these things. They're not always known. As a company, we prepare for all of this. We can serve all our clients regardless. But
what do you see as the main stress right now? Because if it's geopolitics, we talk about it. It's just not really priced in. Is it distress? Is it something actually going under that you worry about, or just multiple factors coming in at the same time?
No, I think geopolitics could create the main stress that we're worried about in terms of oil and gas prices, trade alliances. But I think the surprise would be higher rates because inflation didn't go down. That inflation's been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise. If you had higher rates and God forbid stagflation, you'll see stress in real estate and leveraged companies and some private credit and things like that.
That was JP Morgan CEO Jamie Dimon and Bloomberg's Francine Lacroix from the JP Morgan Global Markets Conference in Paris. Coming up, the morning calls, and then later we're going to talk to BlackRock's Jean Boivin joining us around the opening bell for his outlook on equities. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. from more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg. Context changes everything. South Africa's most important election since the end of apartheid focuses on infrastructure challenges, economic growth, and political fragmentation. Bloomberg's Jennifer Zabasaja reports live from key battlegrounds in Johannesburg, Cape Town, and Durban.
We think that South Africa is an exciting part of the world.
South Africa is a thriving and vibrant democracy.
There's a lot of expectation for the election.
Coverage begins May 27th on Bloomberg Television. Context changes everything.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm at your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Taking a look at the pre-market here, a whole lot of nothing for the major indexes. The S&P unchanged, the NASDAQ unchanged as well. You know, both of these hit new records yesterday. The Russell 2000 down about 0.2%. It's been lagging the bigger indexes. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Wells Fargo initiating coverage on Texas Instruments with an underweight recommendation, seeing multiple headwinds to achieving the company's revenue targets. Next up, Truist downgrading Occidental to hold, expecting minimal shareholder returns given recent debt reduction plans. And finally, Wolf Research upgrading Intel to peer perform, pointing to recent declines and improving gross margins. Very interesting as the chip maker kind of missed out, continues to get lapped on AI. Coming up, we're going to talk to John Bovin of BlackRock Investment Institute. This is Bloomberg.
Biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? It's just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
countdown to the open. I'm Matt Miller. Moments away from the start of trading, we're seeing a whole lot of nothing in terms of the index moves, but a lot of individual movers. The open
So looking now to the market on open imbalance, 40 million to the buy
One of
side.
the stocks we're going to be watching at the open, of course, is Walmart, raising its outlook after gaining market share from price-conscious consumers. They're seeing wealthier consumers move down. A different story over at Under Armour, under pressure after missing estimates. And we go back over to Abigail Doolittle. She's got more on UA. Abby?
Yeah, well, let's start out with the shares of Walmart. We're really looking at a tale of two stocks and retail companies here between Walmart and Under Armour. Walmart right now on pace for its best day since July of 2020. That's the degree of the buying power. And I think that investors are relieved that this company put up a same-store sales that jumped 3.8%, so very solid in the quarter that was. And looking ahead, they did boost that outlook a little bit, as you mentioned, just a little bit. And it looks as though, as you also mentioned, some wealthier consumers who may not normally shop at Walmart, they're looking for breaks and discounts. So that is helping to drive Walmart's sales. It's interesting, though, their ticket price, 4.4% growth, was actually down on a quarterly basis, a sequential basis. On a year-over-year basis, there was a little bit of growth, but it looks like more of that was volume. As for Under Armour, we are looking at the worst day, actually just since March 14th of 2024 of this year, so about 2 months. So this stock has been under some pressure, and they, of course, missed their adjusted earnings forecast missed, but they're also talking about doing a restructuring that will include charges of about 70 million to 90 million that will also have some employee severance and benefit costs in there. So lots of uncertainty around Under Armour right now, down nearly 8%, down more than 8%, whereas Walmart enjoying a nice 5.7% boost on that strong quarter and outlook.
But also, Abby, I mean, hugely different scale, right?
Yes.
I mean, Under Armour has like 8,000 employees and Walmart has more than 2 million. I thought it was interesting that Walmart had a 22% gain in online sales. So a lot more people are using Walmart online, and it feels like that's the biggest driver of sales growth.
Well, that really speaks to the infrastructure that they put into place, over the last several years. Because when you think about Walmart, or at least when I do, I think of people actually going to that big box retail store and picking things up. But they have that infrastructure, and people want the convenience coming out of the pandemic. If they can get the deals and the convenience, they're going there. But point well taken on Under Armour, much smaller company, niche area, and perhaps the restructuring will help them achieve some of the moves that they're looking to make to boost numbers and probably the stock. It's success.
All right, we'll keep looking at it. Abigail Doolittle, thanks very much for that. We're going to have more on Walmart with Greg Mellick of Evercore ISI in just a little bit. Right now, let's take a look at shares of Chubb, getting a big boost from Warren Buffett, the stock heading for its best one-day gain in more than 15 years after Berkshire Hathaway revealed a $6.7 billion stake in the insurer. Alex Semenova has more. Alex?
Hey, Matt. Good morning. Well, the months of suspense over Warren Buffett's mystery stock are finally over. Berkshire Hathaway had previously kept this position private. The SEC had allowed it to keep it confidential in regulatory filings, and it now disclosed its stake in Chubb on Wednesday, a position it had been building since 2023 to the $6.7 billion stake that it is right now. Chubb's stock is up about 6% right now. That's no surprise given how closely people follow what Warren Buffett does. Berkshire is, of course, deeply familiar with the insurance industry, holding stakes in several companies in the industry, including Geico. If this gain holds, Chubb is set to hit its highest level on record. Shares were up about 12% year to date through yesterday's close. Bloomberg intelligence analysts said that this is a classic Warren Buffett investment, and Evercore ISI said that this is giving the stock a slight boost given such a large investment at this point in the cycle. Matt?
All right, Alex, thanks very much for that. We'll continue to watch, obviously, everything that Berkshire Hathaway does. Let's turn back to earnings, though, and focus in on a company that I think we used to have a little bit more under the spotlight. Cisco, I remember when all we ever talked about was Cisco. They're giving a solid sales and profit forecast, indicating customers are beginning to invest in their computer networks again after Chuck Robbins has made a bit of a pivot. Katie Greifeld is here with more. Katie?
And initially, traders were pretty excited about this. Cisco shares shares were higher by about 5% pre-market, but that enthusiasm is going away right now. You can see shares down about 1.4%, even though, like you said, it was a pretty upbeat forecast when it came to sales and profit, like you said, suggesting that maybe that corporate spend is starting to pick up. Let's get into some of the numbers here. For the current quarter, forecasts were kind of in line with estimates. I would say sales will be between $13.4 billion to $13.6 billion. That compares with the average estimate about $13.5 billion. It's a similar story if you take a look at profit, expected between 84 to 86 cents a share. The prediction had been for 84 cents. For all of fiscal 2024, though, a little bit of a brighter story there. Revenue expected between $53.6 billion to $53.8 billion. Average estimate is for $53.6 billion. But the thing that the sell side has been excited about this morning, reading through some of the notes, is Cisco's progress on improving its relationships with hyperscalers such as Microsoft, such as Google. Of course, they had been really relying on their own in-house networking equipment for cloud computing. But when it comes to AI, Cisco now has a line of sight to $1 billion in orders from hyperscalers and others investing in AI. Again, that had been giving the stock a boost pre-market. Different story in the cash trade. You can see Cisco shares down about 1% or so.
Buy the rumor, sell the news. Okay, thanks very much, Katie Greifeld, for that. Tune in to her interview with the CFO of Cisco, Scott Herren. That's at 10:30 a.m. Eastern, right here on Bloomberg TV. Turning now to China, JD.com reporting stronger than expected profitability as Alibaba's profits were seen as weaker. Ed Ludlow joins us from the West Coast for more on Chinese tech stocks. Ed?
Yeah, good morning, Matt. We've actually had an interesting change of direction on JD.com. We're down more than 2%, having opened up higher by more than 2%. It's a story about basically retail strength. JD's top line growth was 7%, compare and contrast with Alibaba's core e-commerce platform, which had pretty sluggish top line growth of 3%. And we know that the story in the quarter, which included key Chinese holidays, was JD.com heavily discounting, cutting prices. But the bright spot in their earnings is also their profitability. It shrunk by less than expected, in part because of cost discipline. And, you know, the narrative around the Chinese consumer, the reason we pay attention to both JD.com and Alibaba is that they're seen as bellwethers for the strength of the Chinese consumer and therefore the Chinese economy. What Alibaba had told us about 24 hours ago is that Chinese consumers have a lot of savings, they have a lot of cash, but it's a highly psychological or sentiment-driven market. And so therefore, it seems like we're learning the winners here. JD seems to be doing well in the online or e-commerce space. Analysts really flagging its strength in the electronics category, core retail categories. Alibaba didn't do as well. There is competition there from Meituan, Pinduoduo, and names like that. We are pairing our losses on JD.com. The other big story you will have seen on the Bloomberg terminal on Bloomberg.com is Michael Burry of the Big Short fame, right? Cyan Asset Management boosted its stake in JD.com by 80%, or its position, making it its biggest holding, but it's not doing much for the stock today. Alibaba, second biggest holding.
Ever since Christian Bale gave that amazing performance, I pay attention to everything he has to say. What is it, Cassandra on X? Cassandra?
Yes, exactly. Cassandra on X. Read the story and look at what he's been buying into in China.
I already read this story, Ed. It was among the most read this morning, and I go through that list pretty religiously. Ed Ludlow there from B-Tech. You can catch him on Bloomberg TV just after Katie Greifeld steps off the set. Joining us now is Jean Boivin, head of BlackRock Investment Institute, to talk to us about his outlook for stocks. And Jean, it's a new record that we hit yesterday, but we are still hearing people come out with even higher targets. I think Brian Belsky now says 5,600. What do you think of the overall of the index?
So we have been, overweight U.S. equities coming into this year. I think there are powerful force at play that's going to drive returns. We've seen a very strong earnings seasons coming through. So the first part of this year for us was one that would be constructive. This is kind of playing out despite a little bit of wobble in April. So this is, I think this is in line with this broader context. We are still thinking, however, that a lot of it is driven by narrative about the macro environment, right? Inflation and so on. We've seen that yesterday. That was a trigger. And that is an extremely volatile narrative story. So I think that's the key lesson this year, is that this keeps changing, flip-flopping. some enthusiasm now, but I don't think we can expect that to stay, stable through the rest of the second half of this year. And we think, the sum total of all that is we are in a higher rate environment for longer, even after the print yesterday. So I think this is constructive, but it's at the same time we're going to see some bumps coming from inflation not being as easily brought back down to 2% as we go through later in this year.
Yeah, so John, I love to look at the single stock stories. I hate to get drawn into the macro debate, but you can't really help it when it looks like the market is placing a bet still on rate cuts, even though we're very far away from the Fed's 2% target, and we're in an election year with a Fed that doesn't like to get political. Is the market wrong here?
Yeah, so I think the market has been changing its mind pretty aggressively over the last 6 months, right? So since December, partly because central banks themselves have been quite a bit changing their tune. So I think now we've seen a Fed in particular over the course of the last few weeks that have sounded a lot more cautious on inflation being under control, a lot more hesitant. They can always flip-flop. They have flip-flop, but I think the bar for them to go back to their optimistic scenario is high. So as a result, I don't think
Brent
July
crude
is very
futures
likely at
rise
this
$1
stage, even though
to
the market started to get enthusiastic about
$83.75 a barrel.
that yesterday. I think the inflation story, even though this is a positive development yesterday, the inflation story is one where underneath all of it, there's a lot of persistence. There's a lot of persistence in services inflation. That hasn't been resolved. What we saw is an unwinding of the upside surprise earlier this year, but we have unwound to a level that is still too high in terms of service inflation. So I think it's going to be hard for the Fed to make a case of aggressive, quick cuts from here, especially how they've changed their tune.
Or any.
But it's not impossible.
I mean, loosening financial conditions at a time when financial conditions are already so clearly loose. What do you think about the corporate earnings story? I mean, Jess Metten wrote a great piece earlier this week about how analysts are pushing up earnings expectations after the first quarter was so well received, and we've had 3 quarters of earnings expansion after 3 quarters of contraction. But how does it look, for example, the S&P, if you take out the Magnificent Seven? How does the 493 look in terms of earnings?
Yeah, so I think this is still very much a concentration story, or at least that's the way we look at it. So we are, as I said, we're overweight U.S. equities. We've been positive on risk in this environment, but it's entirely based on the view that the AI, what we call a mega force, the AI mega force, is very powerful playing out, and we believe in that. So it's concentrated. That's what drives the market. I don't think we have a strong conviction on things necessarily broadening out. And when you see these quarters of earnings season like we've just gone through, there is momentum building up in the earnings expectation that comes out. So I think you want to be a bit careful in extrapolating too much. I guess we shave some of these optimism to some extent, but very, very much believe on the concentrated story here on the AI, which will morph into something else beyond the Magnificent Seven. But it's not a broad-based macro story lifting all boats at the same time.
What about foreign stocks? I mean, I heard the argument on the MLive blog, Bloomberg's MLive blog made this morning, I think, that it's a great time to hedge against risk because we're in this Goldilocks environment, but you're going to see growth really more abroad than the kind of concentrated U.S. win story that we've seen lately.
Yeah, so I think, within the DM world, we are pretty excited about Japan. And I think that at this juncture, exactly, I mean, we believe in AI in the US, but diversification is important in this environment, particularly because we think this is an intrinsically more volatile environment. And Japan is pretty interesting in that context. On its own, I think has a very, bullish story that is with a central bank, unlike any other G7 central banks, that's going to be supportive of the market in our view for the quarters to come. And it has a micro kind of governance story that is happening as well. So Japan stands out and is attractive. And beyond that, I think when you look on the relative valuation basis or just on valuation basis, EM stands out as well. The EM emerging markets. And when you think about tactically, but also more on a 5-year horizon, where valuations matter more, I think that starts to build to an interesting case. So yeah, I think there is now a building case for diversifying away from within DM away from the U.S. maybe to some extent, even though U.S. is attractive, and away from DM to EM.
John, great to get some time with you. Thanks so much for joining us. Jean Bovin of the BlackRock Investment Institute. Coming up, price-conscious consumers flock to Walmart.
I think the real story here is actually below the top line, though. We started for the first time in a long time really strong EBIT dollar growth ahead of sales growth. So starting to leverage in the P&L is really something that the long-only community has been really waiting to see for Walmart. So a really impressive print and probably was a pretty tough quarter for retail.
Good for Walmart. The shares hit a record high. We're breaking down the numbers when we come back. This is Bloomberg.
You actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position. I mean, what's the thinking? Yeah. I mean, like, what's that about?
We're not forcing everybody to be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier. Right? Change is really tough thing for everybody. Should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think about what kind of talents I can have for the next 5 years, 10 years. What's the best way to contribute to the world?
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing
much as men do. We all think it's because they're risk averse, but maybe it was because nobody built anything for them.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I think the real story here is actually below the top line, though. We started for the first time in a long time really strong EBIT dollar growth ahead of sales growth. So starting to leverage in the P&L is really something that the long-only community has been really waiting to see for Walmart. So a really impressive print and probably was a pretty tough quarter for retail in the first quarter. I mean, we'll get more results in the next couple of weeks, but we're pretty happy with the numbers.
Walmart benefiting from a more cost-conscious consumer, and I think online sales as well. Pretty amazing. Walmart shares hitting a record high on better than expected results, with upper income households driving the gains. Joining us now to discuss is Evercore's Greg Mellick. He has an outperform rating and a $67 price target on the stock. Greg, I think it's a fascinating story especially for me, the juxtaposition with Amazon, because, you know, pre-pandemic, Amazon was a cheap place to shop, and I have a very cost-conscious wife. Now Amazon's prices have been floating higher, and she's started to look at Walmart online, which I always think of Walmart as a place you walk into and hang out in. Is that a huge part of the same-store sales growth that we've seen?
It's a big part of it, and I would say, and even Amazon recognizes this, the U.S. consumer is extremely focused on value. And so whether it's Amazon trying to get more products to people faster, Walmart is doing exactly the same thing, and they're really leaning into their strengths, which have always been that strong value. And now
At 10 a.m. Eastern Time, we expect comments from Fed Spar, who testifies before the U.S. Senate Committee on Banking, Housing, and Urban Affairs during the hearing on oversight of financial regulators. Both text and Q&A are expected.
And that's why it's one of our top names and has been this year.
Abigail,
we're also expecting comments from Fed Sparkin, who speaks on CNBC.
Sequentially, they had a change in the average ticket price, but if you look year over year, it's zero. How do they do that when inflation is so much higher?
Yeah, average basket, that 3.9 comp is particularly impressive when you consider that it's all traffic. And that's positive traffic on traffic a year ago that was up, I think, 2.5%, 3%. So that to me is the core underpinning of Walmart. It's you're getting more customers coming more frequently. You know, what inflation is going to be what it is. And they're doing as good a job as they can is trying to suck that out of the system. So overall inflation and the same SKU inflation in the basket, they said was just 40 bips in the quarter. So that's a couple hundred bips below overall US CPI. So Walmart's doing their part to try and squash inflation. But at the end of the day, there's only so much you can do. But they're as a result, their strong value proposition is just winning more customers.
In terms of the consumer, I mean, it's great if you can get consumers to move down, I guess, but ultimately you want growth in all of the segments. Can they do that? Can they keep doing that?
I think you can. I think it's not the key about the Walmart story, and to me why it's changed so much in the past 12 to 18 months. Is it's no longer about just getting trade down or like people that have to go to Walmart. They're people that want to go to Walmart. It's having 400 million SKUs available through third party on Marketplace. It's getting Walmart Plus memberships to grow. It's getting people to sign up for Sam's Club. Sam's Club, again, you showed the numbers there before, but that was also a comp that was about 100 bips better than we thought. So they're using technology and their strong, historic, low cost everyday proposition to bring convenience and speed to consumers. And that's resonating with all income groups.
I'm zooming through your bio on the Bloomberg here, Greg, and looking at the stocks that you cover. I don't see Amazon here. Do you think of the two as direct competitors? Would you choose one over the other?
Well, my partner on it, Mark Mahaney, our internet analyst, we agree that it's a good. Amazon remains a winner. We've got an outperform on it. In our top 5 portfolio, though, I would say that we run across retail. We don't have Amazon in it, even though we think it has nice upside. We think the risk reward on Walmart here is frankly better. At least that's my opinion. And I think it's not an either or. I mean, both combined now, Amazon is up to about 10% U.S. market share of retail, gross market value, and Walmart's about the same. So we could be sitting here 3, 4, 5 years from now talking about, wow, how did we just miss that Amazon and Walmart went from a combined 20% share of U.S. retail to 25 or 26%.
All right.
So to me, it's not an either or. They're both showing that if you put together good prices, great assortment, and faster delivery and speed to help the consumer, that resonates with everybody.
All right, great to get some time with you, Greg. Thanks so much for joining us. Greg Mellick there over at Evercore ISI. Let's get some breaking news now. For that, we go back over to Abigail Doolittle. Abby?
Indeed, Matt. We do have the shares of UBS trading down about 1.4% amid the headline, the breaking news that they are, UBS, considering a U.S. CEO role for Rob Karofsky, who is currently their head of their investment bank. This is to compete more so with some of the other big banks on the wealth management side where there are annuity-like returns. We don't know that this will happen yet, but UBS is considering a U.S. CEO role for Rob Karofsky. It would be a big strategic revamp.
Got it. Abby, thanks very much. This is Bloomberg.
At 10 a.m. Eastern Time, we expect comments from Fed's Barr, who testifies before the U.S. Senate Committee on Banking, Housing, and Urban Affairs during a hearing on oversight of financial regulators. Both text and Q&A are expected, though the text is likely to be unchanged from yesterday's testimony. We also expect comments from Fed's Barr, who speaks on CNBC.
The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost of living.
The United States' ability to spend without constraint is not unlimited.
We're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We do need more innovation, more investment, single market and capital market union, and a relevant trade policy.
Bloomberg. Context changes everything.
Here's your trading diary. Fed Vice Chair Michael Barr testifying before the Senate. That's at the top of the hour. More Fed speak throughout the day with Harker and Mester on deck. And the JP Morgan Global Markets Conference continues in France. We'll have interviews out of that for you. Finally, we round out the week with Richemont earnings. We'll see how many expensive watches rich people continue to buy. This is Bloomberg.
Names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable. Not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering.
Shortly expecting comments from Fed's.
There are indicators that point to the fact that Argentina could really make a strong comeback.
From Fed's Barr and Fed's Barkin.
Leaders like Bloomberg Television and Radio. Context changes everything.
This is Bloomberg.
we're 30 minutes into the U.S. trading day on this Thursday, May 16th. Here are the top stories we're following. Walmart sales surge as the big box retailers continues to attract consumers, particularly from upper-income households. Shares soar, taking Walmart's market cap to $500 billion. It's a different story, though, for Deere, with the machinery maker cutting its profit outlook as demand from farmers slows. We'll discuss what it says about the agricultural industry. And green shoots for Cisco. Chief Financial Officer Scott Herron, he joins in an exclusive interview after the company delivered an upbeat forecast for sales and profit. That conversation coming up in just a bit. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets at the moment, and it's quiet at all-time highs. Of course, we broke to those levels on both the S&P 500 and the NASDAQ 100 yesterday. Of course, we're still hovering around there, but you can see that we're taking a little bit of a breather. The S&P 500 only up by about 0.1%. It's the same story if you take a look at the NASDAQ 100 too. Your big tech benchmark currently higher by about 0.1% or so. But when you're at an all-time high, maybe it's not worth complaining. Meanwhile, you take a look at the bond market here. We are seeing a little bit of a sell-off. You can see that yields on the 10-year currently higher by about 3 basis points, but we're well below where we have been, with the 10-year currently trading at 4.36%. But let's get back to these earnings, because sales at Walmart surging as wealthy shoppers flock to the retailer. The company posting first quarter sales growth along with a better than expected full year outlook. Customers prioritizing staples over those big discretionary purchases. Andrea Felstead of Bloomberg Opinion joins us now. And Andrea, is this a trade down that we're seeing boosting Walmart?
Yes, it is. I mean, Walmart's been one of the big beneficiaries from that surge we had in food prices, consumers being squeezed. So shoppers that, may have shopped in more upmarket supermarkets are turning to Walmart for the value that they're really known for.
And I guess with that in mind, it's probably no surprise that you do see that move towards staples. It's interesting. You take a look at the average ticket. It was flat, but it was the number of transactions that rose. People really just not going for those higher priced items necessarily.
That's right. I mean, this has been a story of the past few years. As we have to spend more of our incomes on the things we need, there's less left over for the things we simply want. The other thing is that food price inflation bolsters the value of sales, and so when that comes down or moderates, supermarkets have to sell more sort of loaves of bread, tins of beans to get the same value of sales. So it was positive that the transactions were up.
And so this, of course, is good news for Walmart. It feels like Walmart can make money in almost any environment. Right now, it's making money from the trade down. I have to imagine, though, that's painful for other parts of the industry, though, Andrea.
I would imagine it is. That what they've talked about is doing a better job on fresh food, doing a better job on general merchandise, fashion, home furnishings. And I was listening to the call thinking the latter is not going to be terribly good news for Target, which has lots of those upper income customers, and they come in for essentials, but they also buy its cut price fashion. So if Walmart's turning its incredible scale on that market, not great for Target, which is trying to turn around its fortunes.
All right, Andrea, really appreciate your time on these blockbuster earnings from Walmart. That, of course, is Andrea Felstead of Bloomberg Opinion. And let's turn now to the broader markets, broaden out this conversation, because joining me now is Mark Spellman. He is Alpine Saxon Wood's CEO on set with me. It's good to see you again, Mark.
Good morning.
Let's talk about what we've learned about the consumer in the past week, because, of course, we have the Walmart earnings showing that trade down. We got retail sales that were a big goose egg, which I think surprised a lot of people. How are you thinking about the strength of the U.S. consumer right now?
It's definitely weakening a little bit, but I think you have to there's a difference between going negative and the rate of change on the upside. And even though it seems like ancient history, the pandemic, I think, still has an impact on these numbers. In so many groups, so many stores had huge, massive 20% plus type of top line things. that has to reverse itself or at least normalize. I think you're definitely in more of that normalizing area right now. But when you look at consumer credit, for instance, which is something I think is a good way to look at how the consumer is doing, the vast majority of consumers are in still very good shape, but there is some weakness. There's some delinquency rises on the bottom end for sure when you see credit card companies on the subprime side of things, definitely seeing hikes in those numbers. Again, keeping it, the math here, yes, it's going up, but from a historical basis, it's actually still pretty low to kind of normal, but it's definitely off the lows.
Yeah, no, it's important to consider that, we're talking about rate of change here. When you think about absolute levels, it's a different conversation. How does that translate into how you're viewing the stock market right now? Of course, we're at all-time highs. It feels like the rate of change in terms of the jumps that we're making, that slowed down a little bit, but we're at all-time highs. Does that maybe normalizing consumer give you any pause?
Fitzbarkin says businesses are still willing to raise prices.
For instance, just from a technical standpoint, I think the move in the market yesterday was very positive. You took out highs and on a lot of volume. From a technical standpoint, you can't ask for much more if you were just looking at charts. And then that top seven has really, the Magnificent Seven has kind of calmed down. I think it's the broadening out, which we have seen, which is something we've been looking for a couple months, is going to continue. That's very healthy for the market. We like to say that 2024 is the year of the Magnificent 493. The evidence I can point to there is the industrial group has done very well this year, was beating QQQ and tech for a while. Tech has caught up recently, but they're both up about 10% year to date. That's very healthy for the market.
Sparkin says the services in particular still feel that they can raise prices.
And I have to ask, what's driving that? Because it's interesting, you mentioned industrials, that's been an on and off outperformer. Utilities are now being talked about as an AI play.
Yeah.
What's driving that broadening out that you see?
Earnings is still the key. Cost cuts have been put in place. So you're seeing some good leverage on the top line. I think there is an element of rate cuts there. If you're looking to cut rates, or you think rates are going to get cut, industrials is a go-to kind of group, historically speaking. So I think that's kind of the backbone there. We think you might get one rate cut this year, but I don't think the Fed's in any rush to cut rates.
Yeah.
Nothing seems to be broken at the moment, and I guess that's the worry that if they don't cut rates, something might break. But right now, we're in the probably.
And Barkin says retail sales data shows consumer spending is good, not great.
I wonder, how much do certain areas of this market really need rate cuts? Because, you focus specifically on the small caps, and you think about some of the maturities that are facing.
Barkin says CPI is still not what the Fed is trying to get.
Balance sheets, and that's been pointed to as a reason to me to maybe be a little bit bearish on small caps. So weigh again earnings and what we see in the economic environment with the fact that we have bond payments coming up.
Yeah, I think that's, while I appreciate that sentiment, I think it's too broad of a stroke. You have to dig down into on a company to by company basis. If you're heavily levered with a lot of maturities, yeah, that's bad. It's definitely bad. But not every company is like that, and those are the ones that we try to find at Alpine Saxon Woods to invest for our clients.
And we're going to get to some of those names in after the break. But I am curious, we should talk about memes, obviously. It's been quite a week. It's only been 4 days. We were up straight up for 2 days. Now it seems like we've been going straight down. Just putting it all together, what do you make of what we're seeing? Because I thought this wasn't
Fitzbarkin says the edge has come off demand more to hit 2% inflation.
I was surprised. And I personally don't think it's a good development as far as the health of the market is concerned. It does show an ebullience that, a bubbling over. And historically speaking, it has been close to tops. Like as you said, 4 days isn't making a trend yet, so we'll see how it goes. But generally speaking, we'll be keeping our eye on it. We don't think that's a great development as far as the market's concerned.
Just quickly, do you think the Fed cares? Do you think Jerome Powell is watching this?
No, I think he cares about PCE, and that's it.
Okay, PCE, not AMC.
Exactly.
So hang tight for just a couple minutes.
No GME either.
No GME, just PCE.
Right.
Let's take a look at what's moving underneath the markets right now. We're going to do that with Bloomberg's Emily Griffey.
Barkin says overall labor market numbers are normalizing.
Under Armour, that stock was hitting the lowest levels since 2010, just after the bell, and it's actually now pairing those losses. The earnings for this quarter for the retailer were relatively strong and in line, but actually their guidance going going forward.
Barkin
was
says job
much
claims
lower
are
than
low by
estimates.
historic
They see
standards,
adjusted
but may be
EPS for
edging up.
2025 at 18 cents to 21 cents. That was versus estimates of 59 cents. And it also sees operating income 50 million to 70 million versus estimates of 352 million, Katie. So a big miss on the forward guidance for the retailer, but the investors don't seem to mind as that stock is paring those losses. Under Armour is also approving a restructuring plan to strengthen and support the company's financial and operational efficiencies. So perhaps investors are catching on to that plan and liking that plan from Under Armour this morning.
So there you go, and it's a good reminder that it is still earnings season, of course. So that's the story with Under Armour. Tell me what's going on with Chubb and Berkshire Hathaway.
Fed's Barkin says, I believe inflation is coming down and we're on the right path.
In a financial company for several months, but the market didn't know what company it was until last night in a filing. It was revealed that it was Chubb. Warren Buffett is building a $6.7 billion stake in the insurer, and analysts across the street are largely positive about this investment. Bloomberg Intelligence said this is a classic Warren Buffett position. Evercore said it's actually
Fed's Barkin says, I do believe inflation is coming down, but it will take more time.
Such a large investment in this point in the cycle. And then Vital Knowledge said that Chubb is a leader in an industry that Buffett knows very well. So that stock is up, paring the gains just a little bit, but still up over 4%, Katie.
Yeah, 4%, not bad. I would certainly take it. Bring it home. Tell me about JD.com.
So U.S. listed shares of the e-commerce, Chinese e-commerce retailer JD.com up now about 3% just this morning. They beat expectations. They were also in an earnings season. And this is even amid a slowdown in the Chinese economy. And you compare this to their competitor Alibaba, which posted earnings earlier this week, which were a little bit weaker. For JD.com, 7% rise in revenue, and that came amid a move to slash prices, particularly in their consumer electronics business.
All right, Bloomberg's Emily Griffeo, great stuff. Appreciate the roundup. Coming up, Deere cutting its profit outlook as slowing farm demand hits the tractor maker. Details next. This is Bloomberg.
Fed's Barkin says the question now is for how long rates need to be held where they are to get the required impact on inflation.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time.
Fed's Barkin says the inflation story is much longer term than what happens in the market.
Well, Deere cutting its annual profit outlook as demand for farm equipment slows. U.S. farmers are poised to see the biggest hit to their income since 2006, and that decline, of course, puts Deere under pressure. Chris Cellino of Bloomberg Intelligence joins us now with more details, and I feel like we saw this from some of their rivals as well. So is this a Deere problem, or is this really an industry problem?
You're right. I mean, it's an industry problem. We expected Deere to cut their outlook.
Fed's Barkin says, I can't say fiscal spending has no impact on the economy.
CNH and AGCO also lowered their outlook this quarter, but this was more of a haircut than we anticipated. They lowered their net income guidance about 8%. To about $7 billion this year, which would imply earnings are going to be somewhere north of $25 a share in 2024, or about 8% below the street. And really, the reduction's been driven by, one, deteriorating global ag markets, and two, a need to manage rising inventory levels as that demand starts to pull back. So you're going to see Deere meaningfully underproduce demand here in the back half of the year. I think the question now becomes, is this enough of a cut to destock the channel?
Well, that's kind of what I'm curious about. I mean, do you anticipate that we could see more cuts, or do you trust that Deere has the management know-how to really manage those inventory levels that are piling up?
Yeah, I think it ultimately comes down to what does the retail demand look like as we exit the year and head into next year. You know, farmers are incredibly challenged right now. We've seen a little bit of stabilization maybe these last 3 months on crop prices, but by and large, they're down year to date. They're down significantly versus the prior year. Farmers have higher production costs. Interest rates are still quite elevated. So farm income is going to be down 26% this year. And on top of that, you have generally weaker farmer sentiment. You have uncertainty ahead of the election. And they've gone out and bought a lot of equipment over the last 3 years. So the age of that fleet has come down pretty precipitously. So we really kind of struggle to see a near-term catalyst for a reacceleration in demand. And historically speaking, these downturns really they don't last 1 year. So we're looking at for a little bit more of a prolonged downturn this cycle.
All right, a potential prolonged downturn there. Deere shares currently off by about 3.5%. Chris Cellino of Bloomberg Intelligence, thank you so much. Let's turn back now to these broader markets with Mark Spellman of Alpine Saxon Woods. And we were talking a little bit in the break about valuations. And of course, you take a look at the broad S&P 500 with that really massive weighting to the Magnificent Seven, and it tells one story. But then you take a look at the equal weight version, it tells a different story. So how are you feeling about valuations?
Actually, surprisingly okay. The equal weighted index, excuse me, you know, you have about a 16 PE, which is very much in the normalized range. It's not an extended level. So that gives us, you know, a lot of confidence that there's stocks out there to be bought, and you don't have to just buy you know, what is working. There's going to be, you know, we have seen year to date a catch-up trade as far as the broadening out is concerned, which we were discussing earlier. I think that's going to continue because there is some reasonable valuations out there. Companies are making a decent amount of money. Free cash flow is at record highs. There's a lot of reasons to continue to be bullish here.
Well, let's talk about some of your highest convictions here.
Taking a look at the Fear and Greed Index, 61 out of 100 equaling greed, and the Crypto Fear and Greed Index, 70 out of 100 also equaling greed. And taking a look at the VIX, currently down 0.64% at 12.36.
It hasn't changed a heck of a lot, honestly, and it's still fairly reasonably priced. Your you know, EV to cash flow is about 19 times. This is a company that's going to grow its top line 15%. That's a hard number to look for, or is an easy number to look for, is a hard number to find. And when you compare it to other names, say for instance, Apple is trading at a higher valuation and its top line is probably going to be 3 or 4%. So we think the backdrop for Google, there's a presidential election, they get under scrutiny. AI is, you know, a bit of a worry for Google. I think the worry is Google makes most of its money, an enormous amount of money and operating margin on search. Is OpenAI going to come out with its own search engine that will displace some Google? And Google's got such big share, there's no, but you know, they have nothing but share to lose when it comes to that. So that's the worry. But we think it's fairly priced. You know, obviously we liked it 24% ago a little bit more, but we continue to own it and we continue to actually buy it, excuse me,
And so, I mean, with Google and some of these other tech names, such as Microsoft, for example, I mean, they are just spending loads and loads of money on AI. And I'm curious, as an investor, what kind of signal do you take from that? Is that a bullish sign that they're investing in their future, or do you wish that maybe they would allocate that money to other areas?
I think they have to be involved on the cutting edge, and how it depends on how they're applying the AI to their core competencies. And you are seeing companies that are doing that. There's adjacent industries which we think from an AI standpoint will benefit. When you look at the data centers, which we've talked about in the past, a company like Equinix, a data center company.
At 10:30 a.m. Eastern Time, we get the EIA natural gas change. Forecast a build of 77 BCF on the prior build of 79 BCF.
Capacity is low.
We also expect comments from Fed's Harker, who speaks on the economic impact of higher education and healthcare institutions. Both a text and a Q&A are expected.
I mean, the growth for that industry will be huge for a long time, but we still like that stock right here.
And I mean, you continue down that thesis, then we get talking about utilities, again, being an AI play. But I agree on data centers. We were actually talking to a CRE investor a few weeks ago who said that it's the hottest asset class right now. So you're seeing it really across industries. But speaking of AI, we have to talk about NVIDIA. Reporting next week, you mentioned it 3 months ago, is maybe a company that you would avoid staring into earnings. Is that still the case?
Yeah, I think, yes. The short answer is yes. I think we're getting there. I do want to see the print, although the competitors and the customers of NVIDIA that have reported kind of indicate NVIDIA's quarter is going to be okay. We're going to wait to see what the print looks like, though.
And does that view extend to semiconductors broadly, to the chips broadly, or is it just NVIDIA here?
I think it's just NVIDIA, because the growth rates have been so gaudy on NVIDIA, 30, 40, and 100% sometimes. I think that's what we really want to look at. The other semiconductor companies have sort of more normalized double-digit stuff, and I think the level of error there is probably less.
All right, good place to leave it, of course, as we look ahead to NVIDIA earnings coming up on May 22nd. Mark, it's great to see you again. Really appreciate your time on this Thursday. Our thanks to Mark Spellman of Alpine Saxon Woods. Now, still ahead, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
The Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
right, it's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, Microsoft reportedly asking hundreds of China-based AI staff to relocate outside the country, of course, as tensions between Washington and Beijing mount. Staff were said to be offered the opportunity to transfer to the U.S., Ireland, Australia, or New Zealand. Next up, we have EasyJet reporting a larger than expected loss in the first half. The budget European airline also announcing that its CEO will step down in January. He joined Bloomberg Television earlier.
I've been with the company now for 7 years. We've gone through a lot of...
At 10:30 a.m. Eastern Time, we get the EIA natural gas change forecast, a build of 77 BCF on the prior build of 79 BCF. We also expect comments from Fed's Harker, who speaks on the economic impacts of higher education and healthcare institutions. Both the text and Q&A are expected.
Canada Goose reporting better than expected Q4 results. The pricey puffer jacket, it's seeing stronger demand in the U.S. and China after months of a slowdown. Of course, we're heading right into summer, so that's interesting. But nevertheless, the Canadian company also announcing a partnership with actress and climate activist Jane Fonda. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Let's take a quick check of these markets right now. We're just about an hour into the U.S. trading day. Things are perking up a little bit. It's still quiet, but the S&P 500 building on gains right now, currently up about 0.2%. We're above 5,300. We're at an all-time high. Feels pretty good. You take a look at the NASDAQ 100. Similar story there, also up 0.2% on those big tech names. Of course, we do have some heavyweights reporting next week. I'm talking about NVIDIA. That, of course, will be very consequential for that grouping of companies. And then a quick check on the bond market. Another quiet day after some fireworks. The 10-year yield currently higher by about 1 basis point. Now coming up, Cisco Systems boosting its full-year forecast as businesses begin to spend on computer networks again. Scott Herron, the company's CFO, he joins us next. This is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
1 minute remaining.
The CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show. This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
10 seconds.
And we are watching shares of Cisco Systems this morning. The stock, it's actually down right now despite reporting a pickup in orders in the last quarter, a sign that customers are investing
Build
in their
70
computer networks
BCF,
again.
build 70 BCF, lower than the expected build of 77 BCF. Fed's Harker does not mention monetary policy or the U.S. economic outlook in the prepared remarks.
Given the fact that analysts are saying that the guide, which some are viewing as disappointing, may just be conservative. First, though, in terms of the quarter, as you mentioned, they beat both the top and the bottom line estimates. One issue, though, here is seeing that the revenue growth over the last couple of quarters down after some growth, so some fluctuations here as well. Is that enterprise customer in place, or what's driving this this little bit of a hiccup here? As for the guide, if we take a look at what some folks are saying is disappointing, but again, Morgan Stanley and Citi both saying it's conservative. Revenue, $53 billion, the estimate of $53.6 billion, a small miss in terms of the earnings as well, and then the adjusted earnings is actually slightly higher. But Morgan Stanley saying that this is conservative and that the June 5th Analyst Day, June 4th Analyst Day, that will be a next driver. Citi also saying that this is conservative. And then finally, Katie, if we take a look at Cisco relative to one of its benchmarks, right now underperforming. Actually, this is a different chart than what I was looking for. This is, but relative to the S&P 500 Telecom Index, if you can just imagine, they're basically neck and neck, about flat over the last year or so.
All right, Bloomberg's Abigail Doolittle, thank you so much. And let's keep the conversation going now, because I'm pleased to say we're joined by Cisco CFO Scott Herren. Scott, it's great to see you in person.
Thanks for having me, Katie. It's great to be here.
I'm going to turn that question right to you when it comes to the guide, because you gave a prediction for fiscal 2025 indicating that revenue growth will be in the mid-single-digit percent range. A lot of people out there saying it's conservative. So is it conservative?
What I wanted to do, so this was our fiscal third quarter that we announced, and normally I wouldn't guide fiscal 25.
Dow Jones surpasses 40,000 points for the first time.
We just acquired Splunk, so that big news for us is we acquired Splunk, we got it closed mid-quarter, and I think the analysts are all trying to adjust now to what does the combined company look like. So what I wanted to do is kind of get ahead of that with fiscal 25, and without doing a fulsome guide, just get enough information out there so that they could narrow down their expectations for fiscal 25. Is it conservative? I think it's a first view of where that's going. You know, I think the encouraging thing for us is we've worked through the supply chain disruptions that we had that caused us to build up a huge backlog. And then we're able to clear, as we got the components in, we're able to clear that backlog. Revenue spiked, and now we're having to compare to those compare points. So the year-on-years are a little bit difficult to actually discern what's happening in the underlying business. We spent some time trying to unpack that for investors yesterday, and we'll do some more of that with the buy side later. So first view, but really just trying to give them enough insight so that the models would start to converge on what we think is the right set of numbers.
So it sounds like you're not saying no, but making the point that it's very early. I mean, 2025, who knows what will happen. But let's talk a little bit more about inventory. You make the point that it feels like you've turned a corner when it comes to a lot of those supply chain disruptions. And what does that say about corporate spending? A lot of people looked at this report and said, there's green shoots there. There's a bit of an uptick. If that's the case, where is that coming from? What kind of customers are we seeing that demand from?
You know, what's really interesting for us, and of course, we've got Splunk added in for just half a quarter. So if you net that out and look at what the core business on an apples-to-apples basis looks like, actually, orders were flat overall, which is an improvement from where it's been, as customers have been really trying to implement the huge amount of product that we shipped out to them in 3 consecutive quarters. We see that ending. We see them getting through implementing all of the product that we ship to them by about the end of this fiscal quarter, which for us will end at the end of July. And as that happens, we're already starting to see demand return and product orders flat. I think encouragingly within that overall flat, growth in security orders, growth in collaboration orders, but most importantly, growth in data center networking orders, which has been a headwind for some time, and growth in campus switching. And I think the campus switching one surprised a lot of people that we're seeing growth there with the sense that, there's more vacant office space than there's ever been. How can campus switching be growing? So I think it's an encouraging sign.
So some tailwinds there, and it took me 3 questions, but we have to talk about AI because, of course, a detail that caught a lot of people's eyes was the fact that you have about $1 billion on AI infrastructure orders in sight. And I guess my question there is that for a particular line of business? Where would that spending actually be taking place within Cisco?
Yeah, it's a great question. That's not a new data point. We put that out there. It's in the back end. So if you think of how these AI models get trained and then get used, which is called inferencing, it's in the back end. So it's networking and optics in the back end. A lot of that going to the big, large public clouds that you'd expect, and the tier 2 AI infrastructure build out is what drives that.
And can you talk to us a little bit about sort of the timing here when investors are thinking about when these orders convert to sales and growth, when we will actually see that? What kind of time frame?
No one's more anxious to see that happen than I am at this point, right? And I think there's a lot of things that have to fall into place for those orders for the line of sight that we have. And by the way, that line of sight is driven by, in each case, especially with the large web scalers, we build a bespoke product for them. They give us the specs, and they're all doing something slightly different. We build a product, it goes through a pretty rigorous testing process, and then you get designed in for a use case. So we know what those use cases are, and as those start to build out, as the infrastructure starts to build out for those, that's when we'll start to see the line of sight turn into actual orders and revenue that come in the door. I think that's going to be more weighted toward the second half of our fiscal 25.
Okay, fiscal 25, we're back there again.
Yeah.
I do want to talk about who that spend is coming from, because there's a lot of discussion about the hyperscalers. You think about AWS, Microsoft, Googles of the world. They haven't big users of Cisco gear, but when it comes to the AI spend, do you see that changing?
Yeah, for sure. And I think you have to go back to when they first started building out the big public cloud, compute. The truth is at Cisco, we missed that initial build out a decade and a half ago. We missed that and learned a lot, actually recovered in that space and built some pretty good traction with the large public clouds just in the compute and storage space. As they start to build out AI infrastructure, it's a different architecture in the back end, and we've gotten ahead of it this time. And we've gotten to the point where we're designed into dozens of their use cases, their specific use cases. So it'll come from the top 4 to 6 public infrastructure cloud providers that you've talked about.
And I do also want to talk about costs, because it seems like analysts, they were a little surprised by the magnitude of the expenses that you're taking on from that Splunk acquisition and some other things. I know that you had announced headcount reductions this past February, but looking forward with that focus on cost, do you think that there's more of those actions coming?
I don't think so, and I'll tell you why. The motivation behind the acquisition of Splunk for us, it fits so perfectly into our own security strategy that we'd laid out and really building a security platform that will be, of course, incorporate all the Cisco products, but third-party products as well, because security will continue to have some element of best of breed in it, so we're going to have to connect to that. So their SIM product fits perfectly within our security strategy. We got not just great technology with Splunk, we got some great leaders with Splunk. And I think one of the other exciting announcements from yesterday's earnings call is we announced Gary Steele, who was the CEO at Splunk, continuing to drive the Splunk integration, but also taking on a new role as the president of go-to-market worldwide for Cisco. And Gary's a guy I've known for a long time. I was on his board at his previous company. He's a great operator. He's a guy that I know well, trust, and he's a great operator, and I think that I'm excited about seeing what he'll do. We have a world-class sales team, and in the hands of Gary, I'm excited to see where that goes.
So Gary Steele staying on, it seems like that is a happy marriage, to say the least. But while we're on the topic of Splunk, before I let you go, I have to ask, what are your thoughts on large deals going forward? Is that something that you're still keeping an eye out, or are you going to sort of stay on the sidelines for a bit?
Large deals on the acquisition front. We continue to generate a fair amount of cash. And one of the interesting things about the Splunk transaction, because the hard work the Splunk team did before we acquired it, it's cash flow accretive to us in the very first year. So it doesn't affect our capital return. And so, if you look at our priorities for capital allocation, first and foremost, it's to drive the growth of the company, and some of that will be inorganic. But it's also, of course, to support the dividend, which we continue to increase on an annual basis, buy back shares at about a $5 billion a year rate. And then if there's excess cash beyond that, that's where we'd look to do something else.
So my two takeaways, okay, maybe the guide for 2025 is a little conservative, we'll see, and of course keep an eye out maybe for some inorganic growth opportunities. Scott, really appreciate your time on what I know is a very busy morning. Our thanks, of course, to Scott Herron of Cisco. Meanwhile, you take a look at the Dow Jones topping 40,000 for the first time. Abigail Doolittle is back here with what's driving that strength.
Yeah, and I just happened to put the Dow on the board today, Katie, in anticipation of that possibility before it happened. Now back below 40,000, but again, as you mentioned, above that level for the first time ever. And a small gain up about 0.2%. You can see the S&P 500 and the NASDAQ 100 up about a similar amount. So we have record highs for the three major indexes and a second day of record highs for both the S&P 500 and the NASDAQ. For the Russell 2000, though, not so much. If we take a look at the small cap index, we are going to see here that index is, in fact, lower on the day. That is being driven, of course, by some of the meme weakness. The Russell 2000 down, not so much, down about 0.3%, but after that huge surge for GameStop, AMC, and Virgin Galactic on Roaring Kitty, showing a meme of the possibility of getting interested again in GameStop, that big surge, and now we've had 2 days of pullbacks. In terms of what this could mean for the Russell 2000, are we going to see an all-time high there? Well below that level, I think 10-12% below that level. But if we go into the Bloomberg terminal and if we take a look at the Russell 2000 here, we are going to see it hitting up against resistance. This is similar, but in a different way to the other indexes. These are not all-time highs. These are recent highs, but the point is we have selling resistance, similar to what we had last spring and summer. Selling resistance at that time, the RSI, or momentum indicator, headed down, and we have a decline. So the question is, are we going to see a break above resistance for all these indexes? Right now, each of the indexes trying, but is the range, you can see this range here for the Russell 2000 pretty well, as its RSI is just kind of sagging there a little bit. Will the breakout be real, or are we going to see some consolidation back down? Stay tuned. Never a dull day, Katie.
Never a dull day. Some big questions there. We'll, of course, see how that one shakes out. Our thanks to Bloomberg's Abigail Doolittle. Now, coming up, the U.S. appetite for EVs. We'll talk to Elizabeth Creer. She is J.D. Power VP of Electric Vehicle Practices, next on Wall Street Week. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From the world of politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything.
All right, it's time now for Wall Street Week, and today we're looking at the impact of President Biden's Chinese tariffs. Wall Street Week's David Weston, he spoke with Elizabeth Krier. She is J.D. Power Vice President for EV Practice about the U.S. appetite for cheaper EVs from China.
Well, the auto industry is a global industry, as you know, and all competition needs to be taken seriously. At the end of the day, the consumer decides. Consumers want choices, new technology, and value. The U.S. EV capacity has now exceeded consumer demand for EVs, and we're starting to see conquest sales through price deals and incentives. Competition is expected to continue to increase, with 10 more EVs hitting the U.S. market this year, particularly in the midsize SUV and truck segments. SUV and truck sales make up over 80% of the U.S. market. In contrast, small cars make up less than 1% of the U.S. market. The $11,000 China Seagull would be in this small car segment. The Chevrolet Bolt, also a small car, under $20,000 with federal tax incentives, during its peak sold less than 0.5% of industry monthly retail sales. I'm not an expert in geopolitical decision making, but consumers are looking for lower cost vehicles within the segments of their preference. There is a void in the marketplace, and this is similar to the late 1980s, early 1990s, when Hyundai and Kia came to the U.S. market looking to fill the void. Whether low-cost EVs are first offered by domestic brands, Asian brands, European brands, or Chinese brands, we'll have to wait and see, but there is a market for them.
But as you just said, Elizabeth, within the segment they're interested in, it sounds like the segment that the Seagull's in, the really small, really inexpensive one, that's not potentially that much of a threat to U.S. automakers.
That's correct. That's a very small segment.
And
1%. But that doesn't mean that they can't bring their same low-cost initiatives to other segments. But that when you ask the for low-cost EVs, that's the type of vehicle that would fit within that category.
So you've been studying consumers and their reactions to electric vehicles. You actually had a report out at the end of March. And as I
U.S.
read
natural
that,
gas
it
futures
isn't so
extend
much
gains.
People really have reason to be hesitant.
Absolutely. We survey over 2,000 new vehicle shoppers every month to gauge their interest in EVs. And when we look at the top reasons for rejection, those who say, I am not interested in an EV, we see lack of charging station availability as the top reason for rejection, but purchase price as the second. So that's where EV education comes into play. There is a learning curve to owning an EV, figuring out where to charge, how frequent to charge, how much to charge. And although for many, charging may not truly be an issue in terms of availability, but perception is reality. And charging is simply too much of an unknown for them. And same goes for price and understanding the total cost of ownership of owning an EV. Often the savings with the EV incentives and operating costs and maintenance for that matter often offset that initial price. But again, this needs to be explained to the average shopper. So infrastructure, price, education, all very important.
Well, it's interesting listening to you, Elizabeth. It sounds like education is a key component here because it's something new, obviously, for most of us. We're used to internal combustion engine cars. Now we're going to EVs. And some of it is, how long does it take to charge? How much do I charge it? By the way, I hear a lot of things about if it's really cold outside, does it lose the charge faster? Is there an opportunity here, actually, for U.S. automakers to educate us as consumers so we'll be more comfortable with this?
Absolutely. You know, I said perception is reality. And for the consumer to learn how to deal with their new EV, they need to understand what it means to home charge, what it needs to charge on a daily basis. You know, maybe the solution is you charge at work every day as opposed to at home. Or when you're on a road trip, that's a different scenario altogether. Road trip folks today in a nice vehicle, they're used to going to the gas station and filling up. But when you're on a road trip with an EV, maybe a better solution is every time you stop, because you're stopping anyway, you just charge because you can. So there really is an education, and customers need to feel comfortable, and to feel comfortable understanding charging and the visibility of charging is incredibly important.
That was Elizabeth Creer of J.D. Power with David Weston. This is Bloomberg.
This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
JP Morgan CEO Jamie Dimon, he says that he's still more worried about inflation rather than the markets. And of course, we just saw the Dow making history, hitting the 40,000 mark rather. Dimon sat down, of course, with Bloomberg's Francine Lacroix from the JP Morgan Annual Global Markets Conference in Paris.
I wouldn't call it turbulence. We've had good, healthy markets for quite a while. They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets which are kind of wide open. That's all good. It doesn't tell you what the future is going to be. I mean, I could point a lot of times in history where that was true, and the next year wasn't true, and so. We'll see. I don't pay as much attention to monthly numbers as most people do.
I know. So what do you think the future is for inflation and interest rates?
I'm a little more worried about it. I mean, we've had very big fiscal deficits. And, I think the underlying inflation may not go away the way people expect it to. And I look at the future, like a lot of things we look at are kind of inflationary. The green economy, the remilitarization of the world, the infrastructure requirements, the restructuring of trade, fiscal deficits. So I think there are a lot of inflationary forces in front of us. that may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation's a little bit higher, and maybe that'll slow growth. And obviously geopolitics is a whole different issue. That could be determinative in what our economy does next year, and we're just not going to know.
But so does that mean you think it's 50-50 whether the Fed cuts or hikes next time around, the next move?
I really don't pay that much attention to that. The Fed will have to follow the data, and I don't know what the data is going to say, but I think they are doing the right thing to be patient right now. See what's going to happen. They may not know for a couple of months.
But no big correction. I mean, if you don't pay that much attention to it, it means you're not worried about anything.
No, I'm worried. I just said stocks are very high, and I think the chance of inflation staying high or rates going up are higher than other people think. So I think the chance, my view is whatever the world is pricing in for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
In the U.S. or globally?
Well, I'd say in the U.S., but also that could affect globally, yeah.
And so what does that mean for markets?
They'd be down. And credit spreads would gap out.
So why is the market not pricing that in?
A lot of happy talk.
Where does that happy talk come from?
Low rates, central banks are going to reduce rates. Maybe the geopolitical things disseminate, don't cause problems, and so the future isn't predictable like that. So I'm a student of history. I've watched all the inflection points. If you go back, my dad was a stockbroker. I go back to the booming markets of '72 and the collapse of '74. The healthy markets of '80, the collapse of '82. The '87 market crash, the 1990 real estate crash, and almost all of them were not predicted the year before. So I look at these factors that drive these things. They're not always known. As a company, we prepare for all of it so we can serve all our clients regardless. But
what do you see as the main stress right now? Because if it's geopolitics, we talk about it. It's just not really priced in. Is it distress? Is it something actually going under that you worry about, or just multiple factors coming in at the same time?
No, I think geopolitics could create the main stress that we're worried about in terms of oil and gas prices, trade alliances. But I think the surprise would be higher rates because inflation didn't go down. That inflation's been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise. If you had higher rates and God forbid stagflation, you'll see stress in real estate and leveraged companies and some private credit and things like that.
And that was JP Morgan CEO Jamie Dimon with Bloomberg's Francine Lacqua earlier. Coming up, we have Bloomberg Technology, Seema Shah from Principal Asset Management. She joins next. That does it for Bloomberg Markets. I'm Katie Greifeld, and this is Bloomberg.
Do you feel like this age of abundance over the last few years of just how much was being made?
For my personal taste, I am thrilled at what I get to find every night if I have time to look for something. So I personally don't think too much was made. I think the customer will tell us when there's too much made and they won't watch things. And I think part of the misalignment I talked about before is imagine if things didn't get picked up or movies didn't get made that people didn't watch or go to see. That's how it used to be. The customer decided. I do think there's going to be less made in the middle price range. I think there's going to be more made in the higher price range because when you get to global events like Barbie or Oppenheimer or Super Mario Brothers, it's worth the investment, and it's clear that the audience is there, and they just need to be given what they want. The middle, which ends up quickly on one of the services in a way that we're watching movies that we don't know how they got made or when they got made and all of that, I think that will probably be curated better, and I hope there's more inexpensive things that give more people the chance to express themselves and have their work seen.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
The US to sell $16 billion in 20-year bonds on May 22nd to settle on May 31st, and the US to sell $70 billion in 6-month bills on May 20th to settle on May 23rd.
We'll hear from the CFO.
The US to sell $70 billion in 3-month bills on May 20th to settle on May 23rd. And the US to sell $16 billion reopened 10-year tips on May 23rd to settle on May 31st.
And a new set of board advisors. But first, let's check in on the
IMF spokesperson says the decline in inflation since mid-2022 peak has been most welcome.
Stocks lift higher. We still get that economic data that, for now, gives us comfort that the US
and when asked about new
strong,
US tariffs on Chinese imports, says the US would be better served by maintaining open trade policies vital to its economic performance.
Maybe selling off a little bit more at the front of the curve, but this is a risk-on day. Let's move on and see whether it's flowing into the world of crypto as well, because we had seen a rally. We're actually down some 0.6% on the last couple of days, well, on at least this day, intraday basis, still holding about a $65,000 level as it stands, though. So it's not all risk on end, but is in the benchmarks. What have you got on the individual stocks?
Well, look, earnings all around the world are going to be a really big story for us. You know, those classic technology names like Walmart, for example, up 6%. But the story there is a really big surge in growth on its online business. As you said, we'll go to Jaewon Kang, our reporter in Chicago, to talk about that. Cisco's now down 2%. It was much higher in after hours last night. And at first, its outlook was seen as strong guidance, and now we wake up and it's seen as conservative. We are going to hear from the CFO, and Bloomberg's Ian King is going to join us on set to break down the networking gear company and also transition to software. And then we go to China, and later in the program, you're going to talk about some of these Chinese names, right? JD.com showing top-line growth 7%, really strong cost discipline boosting profit. But we're learning who the winners and losers are in China right now with the Chinese consumer in the e-commerce context. Alibaba's up 7%, having fallen on its kind of weaker sales. Why? Michael Berry, Cyan Asset Management. JD.com number 1, Alibaba number 2, top holding for them. Maybe we can talk a little bit about that as well.
Yeah, we're going to dig into that a little bit later in the show. And the here and the now is to dig in to investor sentiment more broadly. We can do that across geographies, across industry groups, but really to tackle these record highs. We're with Principal Asset Management Chief Global Strategist Seema Shah joining us. And look, I mean, game on today from a macro perspective. And will it carry on into the tech outperformance, do you think?
Hi, great to be on with you. Look, it's a good risk on day. I think there's fundamental reasons for that. You know, of course, there's a discussion about rate cuts coming back onto the agenda. But I think more fundamentally, we can see that from the economic data, it's slowing. But we're not talking about a weak economy as yet, at least. So this is still a fundamentally strong economy, which means that earnings should be fairly solid as we go through the year. And that should translate into a broadening of the rally, which is why we're seeing so many of the indices reach record highs.
Seema, hey, it's Ed in San Francisco. I've been looking at all the index level energy so far year to date, right? And you look at the NASDAQ 100, S&P 500. I can't believe we showed the Dow Jones Industrial Average at the top of this program today. But I think what I'm trying to find out is if there's any commonality in the direction of the market, and strip out the Mag 7, because I know that that's top of mind for so many people. Is there something in common for this market, or is it still dominated by our view of those single technology names?
So I think those single tech names, they are clearly still dominating the market. They're driving a lot, but what you have seen from the most recent earnings season is that this good performance is spreading out to other parts of the economy. Other sectors have done pretty well. So if that can be maintained, and particularly if you do actually start adding in those rate cuts towards the latter part of the year, that will help the story, particularly for certain segments of the market. I mean, even if you're just thinking about small caps, they need those rate cuts. But overall, this is a broad, good story. We still probably need to see a little bit more evidence in order to secure that perspective. But at least for now, the evidence that is coming in suggests that this isn't just a year for the Mag 7, but it's going to be a year for the broad equity market.
What about the valuations of, well, they're fewer than 7 now when they're magnificent, but more broadly, let's call it chip stocks, let's call it the winning formula of Nvidia, of, well, Alphabet, even Apple getting some lift again now. Are those valuations out of whack?
It's interesting. I was traveling across the US last week, and I was with investors everywhere, and that was a question that still keeps coming up: is do we think of this as overvalued, and is it time for a correction? So we would definitely push back on that. Yes, it's a little bit frothy, but do we make comparisons to the dot-com bubble? Absolutely not. These earnings are somewhat believable, maybe a little bit frothy, as I said, but there's actually something fundamental in those valuations, so it doesn't really concern us. Inevitably, with this kind of market, when there's so much good news priced in, there's always going to be risk of a bit of a pullback. But we look at the tech story as a long-term play, and from a long-term play, we still it's still one of our favored areas of the market.
You talked about the good news that's priced in, Seema. I don't want to bring the mood down, but something we've been talking a lot about recently on the show is the relationship between the US and China, whether it's constructive or otherwise. Is that a headwind you're factoring in right now, particularly when you look at the technology sector?
So inevitably, it's something that we do need to consider, especially when you're going into the presidential election, where China is going to be top of the news as we get closer and closer to that point. So it is something that we consider, but I think it's very much on a single stock name basis, because there's some which are going to be particularly exposed and others which are not so much. The good news from a China standpoint, though, is that from the most recent data that we're seeing come in, there does seem like it's a bit of a cyclical upturn. It's nothing to rave on about, but something at least to lift at least expectations. If that is carried through, then certainly for a lot of those other those bigger multinational tech companies which have got so much exposure to China, it does suggest that they're a little bit less at risk than we would have considered. But certainly the geopolitics is something we always have to watch. But it's not yet at that point where it's changing our perspective on positivity about the sector.
I like that we go global, because look, it's not just US stocks that have done particularly well of late. Japanese stocks on a tear. European stocks 600 been at a record as well. Where are you liking other geographies right now?
Yeah, and it's a great question, because at the moment, I mean, at least for the last couple of weeks, what we've been challenged with in the market is that although I think a lot of people continue to believe in US exceptionalism, they have been confounded by the fact that the rate cut debate continues. We're not very sure about where that's going. When you think about the growth story, you're starting to see economic downside surprises in the US. And then, of course, there's evaluations. So then this is probably a good time to start thinking outside of the US. And there are some good stories. So even if you think about Europe, which is the perennial disappointment, but now you're seeing that we know what the ECB is going to do. We have, I think, pretty much good confidence that there's going to be cuts in June and then thereafter. We know that we're starting to see a cyclical economic upside surprise, not an acceleration, but at least we're seeing some good news come through, and then valuations more attractive. So if you look across Europe, that's fairly good news. And even in China, as I said, given where sentiment was, you couldn't get much worse than that. And now with the economic data seeing some signs of brightness, that is looking like a more attractive part of the market too.
Seema, you're a regular on Bloomberg Television. You're a regular here on Bloomberg Technology. Away from the markets, I wanted to ask you about how you're using AI at work or at home. We're going to be talking later about AI-driven search. What have you been up to in the world of AI?
I mean, I think any company out there has to be embracing AI and trying to figure out where they can use it in any parts of work and home. So from a work perspective, of course, trying to adopt AI into our models, trying to analyze the companies from a single sector, a single stock perspective, that is going to be the easiest way to try and do full analysis and get a full, complete level of information. So that is something that we're trying to bring into work. I have small children. AI is the stuff that they talk about at school as well. So you can see that this is everywhere. It's not just dominated by the finance news.
Principal Asset Management Chief Global Strategist Seema Shah. AI everything all the time and markets. What more can you ask for on Bloomberg Technology? Coming up on the show, we're going to hear from the Cisco CFO, Scott Herren, as the company slides and its outlook is being seen as conservative. That's coming up next. Stick with us because we'll be right back. This is Bloomberg Technology.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
White House economic advisor Brainard says China's industrial capacity and exports in some sectors are so large that they can undermine the viability of investments in the US.
Got to talk Cisco because it's been quite the volatile trade. After hours and in today's trading, we're now off by 1.7%.
Brainard says a new cycle of Chinese policy-driven overcapacity and export surges could have adverse consequences for US workers.
Look, Bloomberg got the chance to discuss all of the results earlier with Cisco CFO Scott Herren. Take a listen.
So this was our fiscal third quarter that we announced, and normally I wouldn't guide fiscal 25 until we get to the fourth quarter earnings call. But, you know, we just acquired Splunk, so that big news for us is we acquired Splunk, we got it closed mid-quarter, and I think the analysts are all trying to adjust now to what does the combined company look like. So what I wanted to do is kind of get ahead of that with fiscal 25, and without doing a fulsome guide, just get enough information out there so that they can narrow down their expectations for fiscal 25. Is it conservative? I think it's a first view of where that's going. You know, I think the encouraging thing for us is we've worked through the supply chain disruptions that we had that caused us to build up a huge backlog. And then we're able to clear, as we got the components in, we're able to clear that backlog. Revenue spiked, and now we're having to compare to those compare points. So the year-on-years are a little bit difficult to actually discern what's happening in the underlying business. We spent some time trying to unpack that for investors yesterday, and we'll do some more of that with the buy side later. So first view, but really just trying to give them enough insight so that the models would start to converge on what we think is the right set of numbers.
So it sounds like you're not saying no, but making the point that it's very early. I mean, 2025 who knows what will happen. But let's talk a little bit more about inventory. You make the point that it feels like you've turned a corner when it comes to a lot of those supply chain disruptions. And what does that say about corporate spending? A lot of people looked at this report and said, there's green shoots there. There's a bit of an uptick. If that's the case, where is that coming from? What kind of customers are we seeing that demand from?
You know, what's really interesting for us, and of course, we've got Splunk added in for just half a quarter. So if you net that out and look at what the core business on an apples-to-apples basis looks like, actually, orders were flat overall, which is an improvement from where it's been, as customers have been really trying to implement the huge amount of product that we shipped out to them in 3 consecutive quarters. We see that ending. We see them getting through implementing all of the product that we ship to them by about the end of this fiscal quarter, which for us will end at the end of July. And as that happens, we're already starting to see demand return and product orders flat. I think encouragingly within that overall flat, growth in security orders, growth in collaboration orders, but most importantly, growth in data center networking orders, which has been a headwind for some time, and growth in campus switching. And I think the campus switching one surprised a lot of people that we're seeing growth there with the sense that, you know, there's more vacant office space than there's ever been. How can campus switching be growing? So I think it's an encouraging sign.
So some tailwinds there, and it took me 3 questions, but we have to talk about AI because, of course, a detail that caught a lot of people's eyes was the fact that you have about $1 billion on AI infrastructure orders in sight. And I guess my question there is that for a particular line of business? Where would that spending actually be taking place within Cisco?
Yeah, it's a great question. That's not a new data point. We put that out there. It's in the back end. So if you think about
Fed bids for 4-week bills total $245.2 million.
So it's networking and optics in the back end. A lot of that going to the big, large public clouds that you'd expect, and the tier 2 AI infrastructure build out is what drives that.
Cisco CFO Scott Herren giving, frankly, a classic class on being a CFO for a technology company. Let's get some clarity on Cisco, its technology and its earnings, and bring in Bloomberg's Ian King. There was a lot of CFO speak in that. Unpick it for us and explain the quarter that's just gone.
Yeah, I think the best way to view it is through the lens of what happened with the share price. We had an initial spike yesterday.
In after hours, right?
Exactly, in after hours trading, and today we're sort of down moderately, a little bit more sober. What really happened, and Scott kind of alluded to that, was the expectation for orders was that they would be down possibly as much as 10%, maybe even more in the quarter that they just reported. Came in as kind of okay, maybe up slightly when you include this new acquisition. So there was like, oh, things aren't as bad as we had feared kind of reaction that happened in the after hours. Then when we go through the numbers and listen to the call, we've seen a reaction this morning, which is more like, yeah, okay, it's okay, but bearing in mind they've just done this massive acquisition, maybe they're not getting quite the kick from that.
Yeah, I mean, we have to take Splunk into consideration here, and there's going to be new role of president, for example, Ian. But what about some of the other partnerships, not actual M&A, but, you know, they had this big fanfare of an NVIDIA deal and partnership. Has that bringing in any much-needed revenue streams?
Well, that is still in the early days, so we don't really know. But, you know, back to the conversation that was had with Scott and the big question of this $1 billion of AI-related orders. Obviously, Cisco wants to go to the party too. At the moment, though, and there were a lot of questions on the call yesterday. Well, what exactly do you mean by $1 billion? Who's giving you these orders? How sure are you that these are real orders and not just an aspirational goal? And there was a lot of to and fro with the leadership team about, you know, what that really means and whether this is real. And really, the bottom line is that investors aren't quite yet ready to let Cisco into that AI party.
Ian, you broke a story literally as we started the show and before you walked on set about Ampere, the chip company, teaming up with Qualcomm to make AI technology, AI infrastructure. I didn't know that Qualcomm was in that line of business. I do now. Give us the details.
Yeah, I mean, what's going on there is Ampere, who we had at our tech conference last year, they're an ARM server chip company trying to get into all of the big hyperscalers. They're teaming up with Qualcomm. to bring in this accelerator to try to basically bring a cheaper alternative to the kind of thing that NVIDIA is selling for many tens of thousands of dollars. We'll see how well that goes. We'll see how well that performs.
I mean, we sat with Renee James, both you and I, individually at various points throughout that event last week, Ian, and she's a breath of fresh air in many ways to the area of computing and the startup side of things. But it looks like there's kind of a trifecta going on. They can't just do it alone. They've got to be working where there's Supermicro's involved, Supermicrocomputer alongside Qualcomm, alongside Ampere. But the key refrain coming from everyone is energy, right? Efficiency here.
Yeah, as you point out, Renee is pretty fired up about this, and she's making a point which many agree, which is we cannot carry on like this. The cost of AI in terms of power, in terms of money, is just too great right now. We need technology answers to that problem. We need more efficient chips. We need cheaper chips. And she's trying to offer that, her company as a solution to that problem.
Well, certainly managing to come out to the market with a combination offering at the moment. Ian, it's brilliant that you got to break it for us. Thank you, Bloomberg's Ian King. Meanwhile, coming up, we're going to be talking about Walmart out with its earnings results. And look, we're going to focus on the e-commerce side because they're playing a big role. 4 billion deliveries in one day, in same day over the last year. Meanwhile, Ubisoft, let's just talk gaming for a moment because it's ugly over there in Europe. We're down by 12.8%, most that we've seen this company's fall in 16 months. It's a video game publisher over in France warning that bookings in the first fiscal quarter will be lower than analysts had estimated. You tweeted this one out, Ed. Well, you posted it earlier. This is Bloomberg Technology.
At 11:30 a.m. Eastern Time, the US sells $80 billion in 4-week bills, prior high yield 5.27%, and a prior bid cover of 2.93%.
From our world headquarters in New York, I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. South Africa's most important election since the end of apartheid focuses on infrastructure challenges, economic growth, and political fragmentation. Bloomberg's Jennifer Zabasaja reports live from key battlegrounds in Johannesburg, Cape Town, and Durban.
We think that South Africa is an exciting part of the world.
South Africa is a thriving and vibrant democracy.
There's a lot of expectation for the election.
Coverage begins May 27th on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power.
This is Bloomberg.
Time now for Talking Tech. First up, Microsoft is said to have asked hundreds of its China-based AI staff to consider relocating. That's all according to the Wall Street Journal. Now, the tech giant has asked its employees based in China to move to a different country, perhaps US, but Ireland, Australia, New Zealand. It's all amid growing tensions between the US and China on technology. Those who choose not to transfer could remain working in the country for now. Plus, Michael Burry's investment firm is doubling down on its Chinese investments. JD.com, Alibaba. Now, according to 13F filings, JD was the firm's top holding after boosting its stake by 80%, with Alibaba coming in second. Now, Burry has been making a return to the Chinese tech sector after exiting them at one point in 2023. And revenue for Baidu grew at actually its slowest pace in more than a year. China's internet search leader, it's struggling to turn its investments into generative AI into actually real revenue, real earnings. They came in at $4.4 billion for the 3 months ending in March. Meanwhile, JD.com reported, well, a better than expected 7% rise in revenue. This after the Beijing-based retailer actually cut prices, ramped up customer perks to counter some of that competition. JD.com's results are seen as one of the key bellwethers of Chinese consumption, which, look, have struggled to recover since the country lifted COVID curbs. Ed?
Yeah, there's going to be a big global e-commerce theme in today's show because Walmart's also out with its results this morning that showed a 22% jump year over year in its online business. This is e-commerce growth principally in the US. Let's get out to Bloomberg's Jaewon Kang, who covers Walmart for us. And that's the story, but what's behind it? What's Walmart been doing with its digital presence?
Yeah, so e-commerce has been a really important business for Walmart. It's definitely one of the factors of growth. And what they've been doing is really adding capabilities like delivering orders super early in the morning. They're also working to deliver their items faster, so same day, or in a couple of hours. They're also improving what the company calls a perfect order, which refers to different metrics like when orders arrive or how complete the orders are. And they've been working on improving all of those things while cutting down costs associated with delivery.
The numbers are phenomenal, and when you're looking at 4 billion items in the last 12 months delivered in same day or next day, that's comparable to Amazon. What's also comparable to Amazon is some of the teething problems that they had back in the day when they started having third-party sellers. Look, I was just sat down in makeup, and makeup artists saying, look, have you seen that there's some fake handbags being sold on Walmart now? I had an issue with my son's gift arriving during Christmas because, look, it was from a third-party vendor, and that vendor didn't seem to live up to the expectations. What's going on in terms of teething issues?
So marketplace has also been one of the factors of growth for Walmart, and it's been
At 11:30 a.m. Eastern Time, the U.S. sells $80 billion in 4-week bills, a prior high yield 5.27%, and a prior bid to cover of 2.93.
That business is the fact that the company can really grow the range of items that it sells online, and they see a lot of opportunities with general merchandise in particular. So this morning they talked about items like pets and beauty. They're going up in sales by more than 30% on marketplace. At the same time, it is a more nascent business compared to selling items in stores, and so we'll see the different puts and takes that they'll test out with that business.
For now, earnings looking very strong. Thank you so much, Jaewon Kang, on all things Walmart. Meanwhile, coming up, we're going to be doing all things search. We're being joined by the CEO of Perplexity, Arvind Srinivas. He's going to talk about the future of search, competitors like Google, also some new advisors to the business. Ed, what have you got?
Stand by for daily GameStop meme stock update. Day 4, we are down, having fallen on Wednesday. Right now, down sort of 24% in the session. There's a story on the Bloomberg about the meme stock frenzy unraveling, but if there's a lesson learned for both of us, I think, in recent years, it's that in meme stocks, 4 sessions a market does not make. Stay tuned. Check out Roaring Kitty on socials. This is Bloomberg Technology.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention.
Shortly expecting the results of the 4-week bill auction, I'll lead with the high yield.
It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. So we started the show by saying we're at record highs across major US equity indices. I want to dig in specifically to tech at the index level. S&P 500, yeah, we're up 0.3%, record high. NASDAQ 100 record high. There's a point of differentiation on the Golden Dragon China index because you have names moving in both directions. Some of the US listed but Chinese automotive companies have been under pressure because of the expansion of tariffs by the Biden administration on those names. We also are in the sort of meat of earnings season for the e-commerce names out of China. Some of them have done well, some not so much, but most of them higher, with that index up 1.2%. The name of the week potentially is Alphabet, the parent of Google. So Alphabet's up for a 4th straight session. A lot of that to do with Google I/O and some of the key announcements centering around a deeper focus on AI-powered search. There was some other stuff in there which we covered in the show yesterday with Julia Lovecaro, but it's another name that's at a record high. Maybe in line with the market, but there is a lot of focus on this specific single name and some enthusiasm about the progress Google is making to combine its search history, pardon the expression, with its work on AI.
And look, there's a lot of other companies in that space. We've been hearing about whether OpenAI is going to be unveiling theirs. And there's a key player that's been making headway for the last couple of years in exactly that. And we're going to get to the business model in a moment. But for now, there's news from Perplexity, the developer of an AI-based search engine platform. It's creating a brand new advisory board that will include Mikhail Perekin, the former head of Microsoft's Bing Research, of course, Rich Miner, Google advisor, Android co-founder, and Emil Michael, former chief business officer over at Uber. Here for more on this news is Perplexity CEO, Aravind Srinivas. So we have this new set of advisors. I'm going to start with the obvious, having just looked at the pictures. Your 4 male co-founders, and you've got 3 men on your advisory board. You are a man of color. I don't need you to preach to the converted. Where's the women? Where's the diversity?
5.27%, 5.27% bid to cover ratio, 2.73, 2.73. The US sells $80 billion in 4-week bills and awards 8.91% of bids at high.
And she's also very helpful in advice. So we have a lot of people from many different diverse backgrounds helping us right now.
Okay, so 1 female board member, 1 observer, 1 investor that you name. That doesn't feel like a lot, but I get it. You feel that there's diversity enough. Many would quibble with that. But let's talk about what these 3 people bring from across the board, across experience. What is it that you need right now in terms of advice?
Yeah, so as a startup, we've been fortunate to scale up so much in such a short period of time. The next step for us is to really think hard about strategy, both in terms of search, how to build our own index, and how to scale it up to even more users, and in terms of how our mobile and distribution strategy evolves, right? So search is all about distribution. They all say Sundar Pichai is the CEO of Google because he really cracked the distribution code through Chrome. So we are working with Emil, who was a former business officer of Uber, who is so aggressive on growth in terms of getting such a large user base. So we need to have similar ideas here. And in terms of mobile strategy,
some would say it was too aggressive.
Yeah, we'll try to tone it down, sure. But look, startups have to be aggressive in terms of competing against incumbents who already have billion users, or OpenAI has 100 million users. We don't have that today. So we have to be, it's on us to do that. And it requires a good mobile strategy too, a great mobile experience. So Rich from Android would be very helpful there. And of course, the core thing is search, and no one better than Mikhail, who used to head Bing. He rolled out Bing Chat Copilot and was previously doing all the search infrastructure for Yandex. So he's going to advise us on building a lot of in-house infrastructure for us.
Aravind, thanks for coming back on the program. I've got to ask you about Google I/O and the real emphasis, frankly, that Google put on integration of AI into search. Specifically, it's like this idea of AI overviews, right? You search for something, it gives you a text answer as opposed to links. A lot of people want to know, what is Aravind Srinivas's reaction to what you saw out of Google I/O?
As the same reaction to what I saw last year when they called it Search Generative Experience. It's just the exact same thing called as a different name. There's literally no change to it. And sure, it's being rolled out to more people, but it's not going to be rolled out for every single query you type on Google. And most important thing when someone uses a product is they should know what's going to happen. When people go to Google, they hate the latency being bad. They expect instant 10 blue links to render. So the moment you start making people wonder what's going to happen, whether that's going to be a streaming of tokens for an answer, or is this going to be links, or whether it's going to be ads, or whether it's going to be some other panels, and a UI that's so cluttered with all these elements at one place versus a single UI just focused for question answering, that's what users are going to decide between Perplexity and Google AI overviews. And I think users like simple, minimal, clean products, so we are pretty confident in our own direction.
Aravind, do you have any information or even just sense that this was Google responding directly to Perplexity?
Possible.
And possible, right? And how do you plan to respond yourself?
By being a better product, by actually working on categories of searches that they're definitely going to be not incentivized to. For example, shopping. If you still, I'm on the SGE experiment already. And when I still type in shoes, I don't get any of the AI overviews. I just get all the Google Shopping cluttered UI. So I still get ads. So there are query categories, commercially intended query categories, insurance, travel, shopping, or education, the universities, for different tuition programs, taxes, all these different categories where all these advertisers are screaming at you to click on them. There's just no incentive for them to put an AI overview for those queries and lose their revenue share.
What's interesting, though, is you actually are built, in some ways you use Claude 3, you also use OpenAI's underlying large language model, and there's rumors that OpenAI are going to come out with some sort of search.
Right.
Would that worry you a little bit more?
Not really. Though their strategy is cleaner than what Google is doing, they're not actually just changing ChatGPT to put in search. They're building out a separate product. But by building out a separate product, you're competing for users from, in the same way as Google rolling out Gemini or Bard. You're not actually taking advantage of the existing user base. And we are confident that our existing work on using many models and many indexes and all the orchestration that we do will still keep us a superior product. But it's good competition. We're definitely going to watch what they're going to release and make sure we execute even faster than what we're doing.
It's competition for talent, it's competition for dollars, because this is not a cheap process to be answering all our questions. Are you fundraising again? There's rumors that you are.
Are there rumors? I mean, I don't know. Look, all I'll say is that we are trying to be as efficient as possible and not going and raising like $1 billion round or something like that. I would say, yes, I agree with you. This is going to be expensive. We would have to fundraise again at some point. But our goal is to get our revenue in good shape so that as we scale in terms of number of people, there's a good revenue per employee, and we're a healthy business too.
Aravind, welcome to Bloomberg Technology. I'm glad that you're in the studio with us today. When we say that you're coming on the show, we get a lot of questions from the audience. Unsurprisingly, there are many Perplexity users out there, right? What always strikes me is how simple the questions are. They just want to know from you what your daily active user metrics are, the latest on the user base, geographically where these people are.
Yeah, so we actually care more about the number of queries we get every single day. That's a better metric for us because that's more directly tied to expanding our index and getting our models in better shape. So we are pretty close to 10 million daily queries at this point, somewhere in the late single digits of millions. So that's actually a really good progress from where we started. So every single month, we are basically serving close to like 190 million queries. And this is only expanding. We started like 1.5 years ago. Looking forward, like we can definitely, for example, Bing Chat served like 1 billion queries in 2023, and we served 500 million. This year itself, we've already surpassed the entirety of 2023 in the first 3 months or 4 months. So looking forward, if we keep sustaining these growth rates, we're headed for a great future.
Aravind, I wrote on Monday in the Tech Daily that consolidation's coming among AI startups, essentially. Have you held talks with a bigger technology company about the potential of being acquired, or do you see yourselves as an acquirer of some of the other smaller names or teams that are out there?
Yeah, so I agree with you on the broader point of consolidation. It's already happening. Like a lot of AI startups that used to be there are no longer there, and like the fewer ones that exist continue to keep getting more and more powerful in terms of user base or market share and APIs. So we've had interest in the past. I'm not going to deny that. And we've also looked into acquiring a few smaller startups. In fact, we made one active hire already, like a company called Spellwise, which helped revamp our mobile team. And we were always looking for like new, hungry founders who are like, even earlier stage than we are, faster at executing than like typical engineers from big tech. And we're always excited about like talking to more people like that.
Aravind Srinivasa, Perplexity's CEO, thank you for coming back on the show at Bloomberg Technology and joining us out of the New York studio. Appreciate it. Sticking with AI, the Senate's bipartisan AI working group, which is led by Majority Leader Chuck Schumer, finally released its highly anticipated roadmap yesterday to provide guidance on congressional efforts to harness AI's benefits but mitigate potential risks. The blueprint recommends $32 billion in annual government spending to support non-defense AI research and development efforts, in part to stay ahead of rivals like China. Caroline.
Long time coming, a fair bit of criticism from some lobbyists over there. But now we're going to take the conversation forward and actually maybe divert into the world of Web3 for a moment. Sergey Nazarov's going to be with us, co-founder of Chainlink, to discuss the trend in asset tokenization. From New York, where we're also looking at Meta shares, talking of all things social media. Look, they're currently under pressure just by 1.4% on the day. Interesting risk-off tone, given that the rest of the market is pushing higher. Meta being suspected by the EU of hooking kids on Facebook and Instagram. Look, this is yet another investigation, this time coming under the Digital Services Act, that could lead to some fines. From New York, for San Francisco, this is Bloomberg Technology.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I had a big insight one day that women don't invest as much as men do. That, we all think it's because they're risk averse, but maybe it was because nobody built anything for them.
On season 2 of The Circuit, we're walking with the titans of banking.
Hello! You guys love these meet and greet things.
Me too! And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass. That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
Let's talk crypto and asset tokenization with Chainlink, a company that connects blockchains and brings real-world data on-chain, and which now works with the likes of BNP, Bank of America, and Citibank. And just in the last few moments has had some pretty significant breaking news. Sergey Nazarov is the co-founder of Chainlink and joins us now. Let's start with that news. DTCC, you have a new arrangement with them, a new relationship. Explain it to us.
Yeah, sure. So we've been working with them for some time now on how to create high quality on-chain digital assets that are driven by data. And so the report that's just come out today shows how data can flow into assets on-chain and prove critical things about the assets on an ongoing basis, which is very different from how the current financial system works, where the ownership of an asset doesn't give you access to data. That becomes your responsibility. So the DTCC report was around something called SmartNav, where Chainlink was used to put critical pieces of data on chain around funds, tokenized funds. And the collaboration included big firms like JP Morgan, Franklin Templeton, BNY Mellon, State Street, and others were part of the pilot with them. And I think what this shows is that real-world asset tokenization is taking a more mainstream institutional interest level, especially the real-world assets that are backed by data. Because the big difference here is that the asset can have critical information about it continually updated. And the holder of the asset or the buyer of the asset doesn't have to search for that data, and they don't need to have any special expertise. And also the data can move across chains. That was the other big part of the collaboration, is how does the data and the asset end up moving across chains. But this is just some of our initial work together, and I'm hopeful there will be more with them and other large CSDs.
It's interesting, of course, because there are many vocal critics of some of the actual coins and investment opportunities when it comes to crypto, but they've always all together now said, but we like the underlying technology. We like blockchain. CEO Jamie Dimon, for example, of JP Morgan. How does this disintermediate longer term financial institutions?
I think financial institutions have a fundamental role to play in terms of compliance and in terms of allowing users to use digital asset products in a compliant way. in relation to their identity, in relation to ways that regulators and CSDs and central banks find acceptable. So I don't think banks are going away. I don't think things like the DTCC are going away. I don't think central banks are going away. I think they're going to use the technology. I think they'll actually be the biggest net users of blockchain technology, and they're going to generate the most assets. They're going to generate the most payments. And importantly, they're going to do it in a way that complies with legal requirements. We're kind of at a place in the crypto industry where if you're at $2.5 trillion, maybe you can go to as high as 10 trillion off of hedge funds and prop traders and the retail community. But in my opinion, if you want to go to the hundreds of trillions that will be in the blockchain format, you need the global CSDs, the central banks, the big commercial banks to basically adopt the technology for its value. Yeah. And that's what this collaboration with the DTCC has been about, is providing that technical value in ways that benefits both the traditional financial system and consumers and the Web3 blockchain community.
This is about, you say, accelerating the investment fund tokenization movement. Which particular real-world assets are we ultimately going to see being put forward on the blockchain first? It's already being done, already being experimented with, but for the audience out there who also happen to be trading equities or in the commodities space, maybe they're a bond syndicate desk, where are they going to see their assets hit first?
So it's actually going to vary by institution and what institutions are good at tokenizing or good at turning into securities. There are basically two categories. There are the core financial products of the current financial system, treasuries, money market funds, bonds. These are being tokenized by bigger institutions, and the benefits of tokenizing them are around collateral management, and they're around diversifying your on-chain holdings so that you're not just holding cryptocurrencies on-chain, you're holding treasuries on-chain. Then you have what are called assets
So in 10 minutes time now at the
These
top of the hour, we expect comments from
not
Cleveland Fed President Mester, who gives remarks on the economic outlook, followed by an audience Q&A. A text is expected as well.
These are the assets that have not been securitized.
For anyone interested, the live video to watch along is available to her entry on the calendar for anyone interested.
Have more press releases about, they hear more about, because they're a more exciting kind of net new product. And I think that there is tens of trillions of dollars in value just in the net new product category. But I am actually seeing both of them happening at the same time. I'm seeing the tokenization of treasuries and money markets and more foundational financial products and very foundational parts of the financial system. And then I'm also seeing the more advanced kind of securitization 2.0 wave of tokenized products. The ones that come to mind are private equity, real estate, and carbon credits.
Sergey Nazarov, co-founder of Chainlink. Great to have you on the show. Thank you. Now, coming up on Bloomberg Technology, the talent war intensifies in the tech world, and ServiceNow is going on the offensive. Stay with us. We'll have the details. This is Bloomberg.
You actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position. I mean, what's the thinking? I mean, like, what's that about?
We're not forcing everybody to be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier. Right? Change is really tough thing for everybody. Should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think about what kind of talents I can have. for the next 5 years, 10 years, what's the best way to contribute to the world?
The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost of living.
The United States' ability to spend without constraint is not unlimited.
We're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We do need more innovation, more investment, single market and capital market union, and a relevant trade policy.
Bloomberg. Context changes everything.
So ServiceNow is beefing up. It's increasing its workforce. It's expanding in enterprise software. How? Pretty simple. They're hiring from a larger competitor, Salesforce. Bloomberg's Brody Ford is here with a very well-read story today because everyone loves to hear about people pinching people from other places, and this is what's going on.
We all love a rivalry. The tech industry loves a rivalry, and we're seeing one here. ServiceNow is a very fast-growing software company. While a lot of other software companies have seen this real, almost depressive environment, they've managed to keep growing quick. They're expanding into new product categories. Where does that leave them? Edging up into Salesforce, right? And so what do? You poach a couple hundred people. And that's what we're seeing here, right? They have hired pretty aggressively from Salesforce. Their CEO's taken some pot shots at them. I mean, they even stopped using Slack once Slack got bought by Salesforce. So we have kind of one of these fun little rivalries bubbling up here, you know?
Emily Chang's going to be speaking to Benioff later today. I'm speaking to Bill McDermott on Monday. Yeah.
2 and 10 minutes time now at the top of the hour. Fed's Mestic gives remarks on the economic outlook. Live video is pinned to her entry in the calendar if anyone's interested. Keep in mind a text is expected in just under 5 minutes time now.
Yeah, I would say part of it is that there's been disruption at Salesforce, right? I mean, they had the big layoffs a little over a year ago. A lot of it I hear is that salespeople got laid off over there. ServiceNow said, hey, we actually need more salespeople with your kind of experience, so come on over. But it's been at the executive level too, right? I mean, ServiceNow's new chief marketing officer came from Salesforce. So I imagine there are some pretty aggressive offers happening here, and it's really across the board. So it's interesting to see what this kind of new infusion of talent does for them. I mean, they've grown their headcount maybe 3,000 over the last year, which most companies have cut by that amount. So it'll be interesting to see how that impacts them.
I love that Bill Patterson is giving you the quote of basically that imitation is the best form of flattery. So it's quite flattering, honestly, that they happen to aspire to be more like us.
The larger company doesn't usually want to engage with this kind of thing because then it validates it, right? So yeah, they kind of poo-pooed the competition.
Oh, well, we'll see how they handle some of the questions from Emily and from our own Ed a little bit later. Brody Ford, always great writing, great explaining. We love having you on. Meanwhile, that does it for this edition of Bloomberg Technology, Ed.
What an edition of Bloomberg Technology it was. Check out the pod. Lots of chat about the pod all the time. You know exactly where to find it. One day left in this fantastic week. Keep with us. From San Francisco and New York, this is Bloomberg Technology.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Shortly expecting the Freddie Mac mortgage rate stats.
Covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
One minute remaining for the text release from Fed semester as well.
In London, these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Welcome to Bloomberg Markets. I'm Shonali Bassick. Equities are surging. The S&P 500.
This is in the text release from Fed semester, who expects gradual progress on lowering inflation. Says downside risks to growth and hiring have fallen. Says risks to inflation side of the Fed mandate have increased. A strong economy means that the Fed is risking little to hold policy in place. Says it will take longer to gain confidence that inflation is moving towards the 2% target. Monetary policy is well positioned as the Fed reviews more data. Current restrictive policy will help lower inflation. Adds that the labour market conditions are strong and welcomes the CPI data as signs of cooling inflation. So with the text release from Fed semester, we also see from Freddie Mac, the US 30-year fixed-rate mortgage down at 7.02% for May 16th week. That's from 7.09% the prior week.
About 5.8%, Target, Dollar Tree, Dollar General, all now facing moves higher of almost 3% or more. And looking at Treasuries, the 10-year yield has been falling recently back to near its lowest level in a month. Even with a couple basis points higher today, you are still seeing the 10-year back above 450 just earlier this month, now back below 440 at 437 on the day. We're going to discuss this now with Loomis Sales Vice President and Co-Portfolio Manager Andrea DeCenso. When you look at these violent moves, really, these rapid moves in the bond market, do you trust what you're seeing at the longer end of the curve?
Well, I think what we saw take place in April was more of a parallel shift across the curve. Front end being driven by that repricing of pricing out some Fed cuts, and the back end really being driven by that ever so concerning deficit spending. Now, what we've seen take place since the inflation print is we've started to see some bull steepening taking place. And that, I believe, is more indicative of the environment we can expect to see into the second half of this year.
What would throw the bond rally off at this point? You just think about how many head fakes we've had in the last 6 months, and do you worry that too much money is piling in at this juncture?
I think what really concerns us is at the core the consumer. The consumer can really throw a wrench in this equity rally we've seen. It can certainly throw a wrench in the shape of the curve, and it can throw a wrench in the yield and carry trade that we've seen playing out across global high yield markets at this point in time.
So how much of a problem is the consumer? If you think about the data so far, you have retail earnings just today alone, for example, and there's been a lot of excitement around it. Though you look at Walmart and you realize a lot of this is because people are trading down. In some ways, should that be seen as a sign of weakness?
I I think it definitely has the early warning indicators, maybe a little bit of smoke to concern us around the consumer. However, taking a step back, we think about what really drives the consumer growth story. It's the top of the income distribution. They drive 40% of that growth. And that consumer overall is healthy. They have healthy balance sheets. While yes, they're carrying slightly higher credit card balances than they were maybe in the last few years, they can cover it with where they are from a credit health standpoint. So I don't think as a whole we should be worried that the consumer headline figures are going to roll over sharply. I do think we have to be concerned about those lower FICO score borrowers. They are certainly in a recessionary environment, and they have been for well over 18 months now.
Well, to the point you're making here, when you have a lot of that spending power come in from the middle to upper end of the income distribution, but the weakness really starting to show at the lower end, when does that start to spill over and become more of a problem?
I think like everyone, people will spend if they have income in their pocket, and they will spend as long as they're not concerned about their job. So as long as those higher income earners are not worried about their job in the next 12, 18 months, they will continue to spend. So seeing that unemployment rate really stay relatively low to historical levels will be important for us as we head into the second half and certainly the first half of next year.
When you think about other cracks in the market, I think there are a lot of questions about what would turn a no landing or a soft landing into something a little bit harder. Do you worry about the data that is upcoming and not what we've already seen that we've seen in the past?
I think, we've been through a tremendous amount of turbulence in the market already. We've gone from hard landing to soft landing to no landing to a growth resurgence. Now we're leaning back towards a soft landing. The soft landing story is probably well supported by the data we're likely to see. Inflation is now moving back towards expectations. That is a positive story when you think about the growth outlook within the US. We're also seeing more green shoots coming out of global markets. You're seeing improving soft data coming out of European markets. You've seen net positive stories coming out of China, the government stepping in further potential ways to support the property market. All of that is a tailwind for global growth. So as we think about how investors are likely to position into the second half of this year, you mentioned it at the beginning of the segment, volatility is low. That is an environment ripe for earning carry, and there are plenty of opportunities across global markets right now to earn high single-digit carry.
Well, speak to more of those opportunities. Of course, in a market so exuberant, you start to look for the risks just to see where we could fall in some of these places, but where are you putting the most money to work right now?
We think global high yield markets are really attractive. Specifically within emerging markets, you're seeing a lot of opportunities in the frontier space. The headlines have been pretty much nonstop. IMF packages, multilateral support. This is an area of the market that is really interesting right now. What is becoming more interesting at this moment in time, as we've seen yields begin to fall and that bull steepening take place, is the dollar rolling over. So again, that local sovereign EM story is really coming back into the fold, and it's an exciting area for investors to look at. Now, we would balance that with some front-end investment-grade corporate exposure because duration is looking interesting again. I think it's fair to say, given the data we've seen, that investors can be comfortable saying nearer term, 5% was likely to be the upside on the 10-year.
Andrea, we have to leave it there. That is Loomis Sales Vice President and Co-Portfolio Manager, Andrea DeCenso. And of course, we are seeing a little bit of weakness in the dollar today as she is discussing, but we have not seen it roll over quite yet. Now, JP Morgan CEO Jamie Dimon says he's more worried about inflation than the markets appear to be. He sat down with Bloomberg's Francine Lacroix at the company's Global Markets Conference in Paris.
I wouldn't call it turbulence. We've had good, healthy markets for quite a while. They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets which are kind of wide open. That's all good. It doesn't tell you what the future is going to be. I could point a lot of times in history where that was true, and the next year it wasn't true, and so we'll see. I don't pay as much attention to monthly numbers as most people do.
I know. So what do you think the future is for inflation and interest rates?
I'm a little more worried about it. We've had very big fiscal deficits. And I think the underlying inflation may not go away the way people expect it to. And I look at the future, like a lot of things we look at are kind of inflationary. the green economy, the remilitarization of the world, the infrastructure requirements, the restructuring of trade, fiscal deficits. So I think there are a lot of inflationary forces in front of us that may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation a little bit higher, and maybe that'll slow growth. And obviously geopolitics is a whole different issue. That could be determinative in what our economy does next year, and we're just not going to know.
But so does that mean you think it's 50-50 whether the Fed cuts or hikes at next time around, the next move?
I really don't pay that much attention to that. The Fed will have to follow the data, and I don't know what the data is going to say, but I think they are doing the right thing to be patient right now. See what's going to happen. They may not know for a couple of months.
But no big correction. I mean, if you don't pay that much attention to it, it means you're not worried about anything.
No, I'm worried. I just said stocks are very high, and I think the chance of inflation staying high or rates going up are higher than other people think. So I think the chance, my view is whatever the world is pricing it for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
In the U.S. or globally?
Well, I'd say in the U.S., but also that could affect globally, yeah.
And so what does that mean for markets?
They'd be down. And credit spreads would gap out.
So why is the market not pricing that in?
A lot of happy talk.
Where does that happy talk come from?
Low rates, central banks are going to reduce rates. Maybe the geopolitical things disseminate, don't cause problems, and so the future isn't predictable like that. So I'm a student of history. I've watched all the inflection points. If you go back, my dad was a stockbroker. I go back to the booming markets of '72 and the collapse of '74. The healthy markets of '80, the collapse of '82. The '87 market crash, the 1990 real estate crash, and almost all of them were not predicted the year before. So I look at these factors that drive these things. They're not always known. As a company, we prepare for all of it so we can serve all our clients regardless. But
what do you see as the main stress right now? Because if it's geopolitics, we talk about it. It's just not really priced in. Is it distress? Is it something actually going under that you worry about, or just multiple factors coming in at the same time?
No, I think geopolitics could create the main stress that we're worried about in terms of oil and gas prices, trade alliances. But I think the surprise would be higher rates because inflation didn't go down. That inflation's been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise. If you had higher rates and God forbid stagflation, you'll see stress in real estate and leveraged companies and some private credit and things like that.
Of course, that was JP Morgan CEO Jamie Dimon speaking with our own Francine Lacroix. Now, coming up next, we're going to speak to Citigroup's Harold Butler to discuss his outlook for the banking sector, especially when it comes to underrepresented communities. We're going to talk more about that next in this higher interest rate environment. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
Wow.
of politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything.
This is Bloomberg Markets, and I'm Shonali Basak, and we're looking at copper prices because they have been rising for months, and now we're seeing a spike that is rocking metals markets worldwide. We're going to discuss what's going on there with Bloomberg Intelligence commodity strategist Mike McGlone. You see the volatility, and it could be quite stifling for some. What does it look like under the hood?
Hello, Sonali. It looks like it's peakish, unfortunately. We've seen some pretty significant future shenanigans. That's mostly the CME traded copper making new highs around $5.13 a pound. And the LME traded copper hasn't. So it's the CME traded copper is getting way too stretched, a little bit long. Futures positions are in there. The thing that's unique about it is it's the curve. So it's only the front contracts that are breaking out. The back ones have stayed behind. And that's usually what happens when markets make peaks. I remember silver in 2011, when it made a peak around 50 bucks, it had a similar nuance. The question is duration here.
Well, you're talking about shenanigans under the surface as well. I mean, part of this issue that we're seeing for traders is a massive short squeeze going on in the markets. Talk a little about the market structure dynamics we're seeing here.
Well, that's the unique thing about it. In a short squeeze, you see open interest decline. But on the CME traded contract, the one that really spiked, it hasn't declined. It's really declined on the LME traded contract. And I've been pointing out, if you look at managed money net positions, i.e. hedge funds, these are the leveraged traders, they're about the most long copper, about 30% of open interest in almost 3 years. So the market's been very long, as you pointed out. It's been riding that rally. So what's happening now is some of the nuances, I think, of trading within the front contracts between the back contracts. And what's unique is when you get that front contract in copper, it got to about 6% above the back price, the 1 year back. That's the most it's done since 2008, which is a bit of a dicey number.
What about the leverage under the surface? You alluded to some of the levered contracts being the most hit here, really. So how big is that exposure?
Yes, so right now, the total net longs from hedge funds, called managed money net positions, as of the last reading was about 30% of open interest. That's the highest in about 3 or 4 years. Right when copper was making its peak right before Russia's invasion of Ukraine and then headed lower. So that's an example of the problem. The market's way very long here now, and it's showing that lately. It put in the spike around 5. It's tilting now back around below 5, around 490 at the moment. So to me, the risk is that those positions might be sparked to liquidate. It now needs some kind of fundamental backing, and it had that little spike to cover some of the shorts. So that's the unique thing about it. Positions are a bit long for a short squeeze.
Mike McGlone, we thank you so much for keeping an eye on a complicated market. Of course, one that has a lot of implications to many items really around the world. That is Bloomberg Intelligence commodity strategist Mike McGlone. Stick with us through the break. More markets ahead. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election?
It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
This is Bloomberg.
This is Bloomberg Markets, and I'm Shonali Basak. Now, Siemens saw orders drop and revenues stagnate in the fiscal second quarter. CEO Roland Busch spoke with Bloomberg's Oliver Crook earlier. Take a listen.
There's a couple of elements which seems that it takes a little bit longer to recover, and let me go through them. Number one is the private consumption is not picking up. Consumers are sitting on a record high savings level, so there's a little bit of confidence missing, number one. Number two, the construction sector, which was really driving momentum, is really going down now. This is by design. It was just overheated. Then we have a lower direct investments going into China. Reason is companies are also starting to increase their resilience, investing in other areas, which is another element. And so this package, this altogether, is somehow still holding China back. China, they are issued now some measures, for example, subsidizing the replacement of white goods with more energy efficient one that will come. But again, it takes some time and it goes slowly.
I may add another list to that list of the things that might be slowing China down, which is that we've got the next couple of weeks, the EU is going to give the sort of outlook on what they're going to do for Chinese EVs. Just this week, we got more tariffs from the Biden administration on many of the products in the Chinese economy. Do you think that will delay the Chinese recovery substantially?
Well, I mean, indeed, you have one point. The export is also not that strong for the global economy. Is not pulling products so much as it used to be, because China, China is an export market, and the tariffs don't help. I mean, tariffs, in principle, they are triggering then counter tariffs, which is not good. In general, this increases the price for consumers, which we don't believe is a good idea. At the same time, if the argument is about overcapacities in the automotive industry, for example, there always have been overcapacities. So what's the level? Does it really impact too much? I didn't expect really that the Chinese market would really substantial flooding the American market with the EVs. I don't believe that this is such a strong demand there. Same for Europe. So therefore, I do not believe that this has huge impacts. But I mean, this tariff and counter tariffs is maybe not what we want to see in a market which is start to picking up in growth in general.
Yeah, and I'd like to get your perspective on that question of overcapacity, because if you ask a lot of the European countries and politicians who want to see a green transition, kind of what you need is overcapacity in certain things like, say, solar panels and these sorts of things. But what do you make of this argument that China is exporting all of this overcapacity to the world?
I mean, the argument goes back that they say there's an over-subsidizing of certain, over-support subsidizing of certain sectors, which causes overcapacities, and they are offloading it to the market. I don't believe that too much. I mean, take this solar industry, solar panels. I mean, most of them are coming anyhow from China. So it's maybe a good idea if you want to drive the energy transition that you get cheap panels from China in order to really drive the energy transition. That's what we want. We want to increase our photovoltaic. So therefore, I do believe this is an argument which we have to look a little bit deeper. We do not believe in increasing of tariffs. Free trade is good and low cost of goods, which are driving in particular our agendas, and one of them is reducing carbon footprint. Mm-hmm. So therefore, I hope that this is not the start of a tariff race.
And then I want to go from China to Germany and our, the home market here. Do you feel that sentiment is beginning to pick up in Germany? Do you see a recovery in the economy?
Well, not yet. I mean, you saw the latest news on the GDP expectations. Germany more on the lower end. There are a lot of things, structural things, which we have to do. We have to work on our infrastructure investment. We are still talking about our Schuldenbremse, so putting a brake on our debts and our debt of the government. So at the same time, we need a lot of investment.
Do you think the debt brake needs a reform?
Now in defense, we're investing. You have to. Pardon me?
Do you think the debt brake needs reform?
We have to. Well, I do believe that selectively it makes sense to do that. I'm pro really a tight hand on budgets. We should really be tight on our money. And again, there's a lot of inflow of taxes. But the other side, we have a kind of an underinvestment, for example, in infrastructure over so many years. It's an underinvested distribution grid and transmission grid. So to catch up that, at the same time put a brake on spendings is something that is contradictory. So my point is we should have maybe picked up the point in saying we have to invest over, let's say, outdated infrastructure. And this goes also into schools, universities, so the education system and the like, and then start putting a harder brake on it. So there might be a selective release would be a good idea. We need Germany to do some basic homeworks. Again, this is the infrastructure, it's education, but also others, like we have to manage our immigration pattern. We need an inflow of immigrants. And this is the reason why we are voting now for openness, tolerance, and respect for people.
Now, I want to give you a check on the markets as well, because of course we're hitting history today. We have the Dow Jones Industrial Average breaking 4,000 and another set of records being reached by major indices. The S&P 500 still up more than 0.1%. The NASDAQ 100 still up more than 0.2%. And the Philadelphia Semiconductor Index almost up 0.5%. I want to flip up the board here because I want to show you where the market is broadening and not. You are seeing some love come back into the Russell 1000 Value Index. This now is an index that is up 8% on the year, not seeing the same gains that you're seeing in those much larger indices here, but you are seeing a bid back in value, and you're seeing it even more than growth. Flip up the board once more, and you can see the Russell 1000 or 2000 Growth Index here. You have it 5% higher on the year and a little bit actually lower on the day. So a little bit more love in value today, especially as you see those retailers and consumer stocks continue to hold on strong. Now I want to bring you the yield moves as well, because of course we are seeing a little bit of a sell-off in the bond market, ever so slightly after a giant bid throughout the week. But what it's led to, interestingly, is an inversion of that 210 curve, still at about 41 basis points. We'll keep an eye on that. But coming up, we have a big interview with Harold Butler, head of Diverse Financial Institutions Group at Citigroup. We're going to talk to him right after the break. This is Bloomberg.
In global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable, not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
This is Bloomberg Markets, and I'm Shonali Bassick. I'm joined now by Harold Butler. He is head of Citigroup's Diverse Financial Institutions Groups, which does work with minority-owned banks, diverse broker-dealers, and asset managers. And Harold, you started this group at Citigroup in the investment banking division about 3 years ago.
That's right.
How big has it gotten since then?
Well, it's gotten size-wise. We're still a very nimble team, but it's began, and it's important probably to note, it began with us being very intentional behind our commitments that we made to help reduce the racial wealth gap in America. And while it started with, you may remember PPP, started with PPP, and then it expanded to a whole host of things, right? And so when I think of size, I think really about the fact that where we began was providing access to a window to sell, for banks to sell debt, to now maybe in the last 18 months having done nearly $3 billion worth of revenue generating opportunities exposed to the banks and the broker dealers and asset managers we work with.
Now, so it's interesting. About a week ago, you had compiled several dozen people from across the country,
Yes.
from different broker dealers, from different asset managers, but also members of the administration and your own executives. Ultimately, when push comes to shove, what has changed for these broker-dealers in this country? What still needs to change?
Yeah, it's a good question. I think for the most part, if we talk about banks, there's been tremendous progress, right? And I like to think of it oftentimes as we've put some seeds in the ground, and the administration, corporates, certainly our efforts have done a good job of sort of watering those seeds, and they're starting to sprout now. For the first time in maybe 4 decades, these banks are very well capitalized, right? And so I think the next step is helping them to put to use that capital that many of them have gotten with government programs like ESIP, tremendous. You mentioned the administration, members of the administration that came, Deputy Secretary Adeyemo really of Treasury highlighted some of the work that Treasury is doing to help with this effort more than just the ESIP. So there's been a lot of change in the space. I think what's important is that we continue, like I said, to water this so it can foster and bloom. And
well, to that end also, this is all happening in the middle of what has been a lot of pressure on the regional banking industry in particular. When you think about regional banks, it's really a lot of communities across the country that need these banking services the most. What role have Black-owned banks done to step into that void in the last year?
Tremendous role, right? So if you think about it, many of the community-based minority banks, they are the community, right? They're the trusted folks for the community. If it were not for some of these banks, many loans wouldn't happen in some of these communities. I oftentimes, and I think maybe on a previous occasion, with you, I mentioned that in many ways, those banks, I think of it as those banks being the heartbeat of a community, and where the heart beats to the various appendages like on our bodies, there goes investment and opportunity to grow within the community. And they're terribly important, which is why, Sonata, we really do the work that we do, is just so we can help empower and uplift those communities through the banks.
What are the challenges? In this kind of higher interest rate environment, we have seen from a lot of banks the struggles that's placed, whether it's higher deposit costs for the banks themselves, or whether there's issues in the loan books.
Yes.
What are the challenges that you're navigating now among your clients?
You know, I think most of the challenges, and I'm going to speak specifically for the banks, obviously broker-dealers, it's about access to more deals, right, from issuers, and really having an opportunity to do those deals and show their stuff in the market. But for the banks themselves, you know, they got, as I mentioned, a great deal of capital today. Now it's about unlocking that liquidity and putting it to use, right? Deposits were a big theme at the conference this year to talk about, you know, how do we attract more investment by way of patient deposits so that that liquidity can then be lent to make loans, affordable housing. Affordable housing was a big pillar around, you know, how do we make more of an impact was a big focus of the Treasury Department as well, to talk about how do we unlock value and create more affordable housing. I think you know Citi is the largest affordable housing lender in the country. So it's about doing more of the things we do very well today and through partners.
You mentioned broker-dealers,
Yes.
and it's interesting because you're seeing the capital markets come back. You know that very well.
Yes.
At Citigroup, everyone in the banking industry is starting to feel the love once again.
Yes.
You know, interestingly, when you see a lot of these banks really underwrite IPOs, those big bulge bracket banks, you see women and minority-owned broker-dealers increasingly show up on these S1 filings. You see them on bond documents as
That's
well. What does the process look like? If you are Citigroup, how do you kind of encourage more of your clients to be doing that at the end of the day?
You know, this may sound simple, but the reality is I think we just need to be, and we are, just intentional about these efforts, right? It's really not rocket science, and I think it's a matter of knowing, and we do treat them as clients at Citi, knowing what the capabilities are and including them. We do have to speak to issuers, right? And we do have to sort of help shine the light on their capabilities. But I think we have to be better at being intentional, and I think the whole market benefits when we do that.
No, it's interesting. You mentioned affordable housing. I'm glad you did, because a lot of people are complaining out there about this idea that we're in a different type of housing crisis today.
Yes.
What does that conversation look like for you inside of Citigroup with these diverse financial institutions? And also you had mayors at this event as well.
Yes, I think, you know, when we think about affordable housing, for these banks, it's about helping us to reach the opportunities that will afford us the ability to support affordable housing transactions, right? So we do a great deal of business in certain parts of the country, but we're not everywhere, right? And I think for the banks, it's good for them, right? Because they know the communities, and if we're able to help them with the tools and resources necessary to realize those dreams of affordable housing, that's positive on the lending side. But local municipalities, government, certainly the Treasury Secretary has mentioned, Deputy Secretary has mentioned several times, you know, his desire and the focus of the administration to focus and go deep on how to unlock value in that space. And so I think it's again, we go back to intentionality, right? It's about really looking at what the heartbeat of the problem and putting resources to solve it.
Getting more houses into American ownership. Harold Butler, head of Citi's Diverse Financial Institutions Group. We thank you for your time. Now coming up, Walmart shows strength in consumer behavior, shares hitting an all-time high. Details on the big retailer next. This is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of ON's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined ON as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but ON's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
This is Bloomberg Markets, and I'm Shonali Bassick. And Chubb shares are rising after Berkshire Hathaway unveiled a $6.7 billion stake in the insurance company. The SEC allowed Berkshire to keep the investment confidential since last year. We're going to discuss this with Bloomberg Intelligence analyst Matthew Palazzola, who knows the ins and outs of the insurance world, where, of course, underneath the surface, it does get very exciting because this is not only a massive stake. You've written about it. It brings to the question whether there are more deals to be done at scale in the insurance industry now that Berkshire and Chubb are so aligned.
Yeah, I mean, look, these are two titans of the industry. When I heard the news, kind of my ears perked up. Berkshire and Buffett have been on this hunt for an elephant-sized acquisition. I started looking, the market cap of Chubb is about $100 billion. Berkshire Hathaway has $188 billion of cash, although I don't think this combination may happen, but it is possible.
Well, speaking of this combination, if it doesn't happen, and if you're Chubb and you have a massive rival having that large of a stake in you, do you worry at all? What's the motive, you think?
So I don't think Berkshire doesn't really go hostile, so I don't think it's really a problem. If you look at the business mixes of the companies, Berkshire with Geico is big in personal auto. Chubb's not that big there. They're also massive in reinsurance. So Chubb has a reinsurance business not as big as Berkshire's. So their business mixes are kind of complementary a little bit. Honestly, it is surprising, but if you take the insurance side away, right, it is a company that Berkshire and Buffett would want to own.
Well, also, you brought up an interesting point here about how succession could play out, because Evan Greenberg, of course, the son of Hank Greenberg, who built AIG into a behemoth, and then, of course, Spot Chubb, Evan himself has been quite a giant in the insurance industry. Can Evan be a senior leader at Berkshire?
I mean, look, if that were to happen, Evan Greenberg's probably not going to work for someone else, right? So in a situation where this hypothetical combination could occur, Evan Greenberg taking over, I think that might be one of the only positions in the world where he would be interested in combining with another company that's bigger than Berkshire, right? If he could run that whole empire. Ajit Jain, who is the head of insurance operations at Berkshire, he's 72 years old. His potential retirement and succession did come up at the annual meeting. I'm not saying it's necessarily going to happen anytime soon, but I think that might be the only condition under which Evan Greenberg would go work for Berkshire.
And of course, we know Ajit Jain himself is a giant in the insurance industry. Thank you so much, Matthew Palazzola. That is Bloomberg intelligence analyst covering Berkshire Hathaway and the insurance industry. And now it's time for Stock of the Hour. Walmart posting another quarter of strong sales growth as it attracts customers looking for essentials and for discounts. The retailer now expects adjusted earnings to come in at the high end for the full year. We're going to discuss this with Bloomberg Intelligence's Jennifer Bartashis. You know, one thing that really struck me in these results is the idea here that, yes, they were promising, but they also showed a trade down in customers. They almost went up the hill in customers here and brought in more customers that would have otherwise been spending on larger tickets. What does that say about the Walmart consumer base?
Well, what it says is that the Walmart consumer base continues to expand, and that really is only good news for Walmart. They've traditionally had very strong appeal with lower income households. The fact that they're pulling in higher income households who are spending more and have more flexibility to spend on higher margin categories is a positive. The question is going to be whether they can continue to hold on to those customers once some of those inflationary pressures that has everyone retreating into their spending habits, once that subsides, can they hold on to those people?
Well, the other thing that really struck me was the e-commerce here. The